have to really keep in mind vaccination is the first line of defense. And at the end of the day, whichever vaccine you take is going to be better than no vaccination.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Welcome back to Bloomberg Markets Europe. 7 minutes until the start of cash equities trading here in Europe. And equity market futures point to the downside. US futures fairly flat, though. Let us get into the details. Stocks to watch on the mind of Tom Mackenzie, anchor of the European Market Open, who joins me on set this morning. Tom, what are you watching? Let's start with, as I mentioned, just ahead of the break, Airbus.
Yeah, another big deal for Airbus. It was flagged that maybe this was coming. We got, of course, the deal with Qantas. Now they've got this deal with KLM Air France for about a $10 billion worth of aircraft, at least at the list price. So 100 A320neos and A321neos. Also the option to buy an additional 60 by Air France, KLM, and also some of the freighters as well, potentially 4 freighters, the A350s. So a big win there for Airbus, again, on the back of that deal with Qantas. Both airlines, KLM Air France and Qantas, switching up Boeing for Airbus.
Okay, and let's get to the chip sector. ST Micro in focus. What's the news flow?
This is really about what's happening with Apple. You saw Apple selling off almost 4% yesterday. You also saw the semiconductor index in terms of the Philadelphia Semiconductor Index falling almost close to 4% as well. So we know that Apple is bringing some of its production of semiconductors in-house, these high-frequency RF semiconductors. So we'll see if there's going to be a read-through to some of their suppliers. ST Micro is one of them. Bloomberg Intelligence, though, cautioning that this is going to be at least a 2 to 3 year process before Apple can really cut off its suppliers of these chips.
We started this hour with some news from the car sector. European car registrations falling 17% to a record low for the month of November. And this is, what, the 5th month in a row we've seen this fall. What does that mean for autos?
Well, of course, we're just watching the auto sector broadly. I picked out BMW. We could pick out any number of auto manufacturers here in Europe on the back of these continuing numbers that look very bleak for the sector. Of course, there are the supply chains concerns, and Omicron is also a factor. Falling 17%, as you say, it is the worst on record since they started collecting these numbers in 1993. So see how it plays out for BMW, but also the rest of the players across the sector.
Tom, thanks so much. Thanks for bringing us those stocks to watch this morning. Tom Mackenzie, our European Market Open anchor. He'll be back to take you through the Market Open with Francine Lacroix. They'll be in position for the top of the hour to tell you how the markets open up. The market's expected to open down. That's what the futures picture has been suggesting. We have had, though, better news from South Africa. We need more detail to work out just how much we can rely on it, perhaps how much it'll mean for the rest of the world. But better news for a Friday. This is Bloomberg.
Lots happening on Wall Street.
The basic.
Welcome to the European Market Open, everyone. A minute to go until the start of cash equity trading. I'm Francine Lacqua in London with Tom McKenzie.
Good morning. Here are your top stories. Central bank divergence. While the Feds and the BOE see inflation as the main threat, Lagarde's ECB sticks to its pandemic-era monetary policy. Turning up the heat, the US pushes EU allies for broader sanctions against Russia as the bloc fails to agree on a solution to its gas crisis. And the lira tumbles to another record low. The Turkish central bank cuts its key rate and says it's ending its easing cycle.
Now, Tom, let's take a look at the futures. Again, we saw a little bit of pressure coming really from the technology sector. Markets trying to weigh in what the inflationary pressures mean for supply chains and things like that, and also what it means for the economy. So we did see a sell-off when it came to technology stocks, and that's really filtering through some of the futures here in Europe. DAX futures down 0.3%, Ftse 100 futures down by a similar amount.
Yeah, it was a whipsaw environment for those particularly invested in the tech sector. You saw that play out in the NASDAQ just over the last few days. Gains on the back of the content and comments from Jay Powell. Then that big sell-off yesterday, and the read across now to Europe as, of course, as you're saying, Francine, we're weighing up those inflationary risks, the shift and the divergence among central banks, with, of course, that continuing spread of Omicron. The politics in the UK as well, increasingly fascinating. The Spanish IGEX currently down 0.7%, in line with those futures that we saw. The CAC Cajon is also lower by 0.3%, maybe getting a bit of support from Airbus. We'll see how that stock is playing out on the back of another big deal. And the Ftse 100 here in the UK flat after that announcement by the BOE, the raise in rates by the Bank of England, taking some by surprise, again, as that central bank weighs up the inflation picture versus Omicron. There's still, though, a view that the bears on sterling have something to go with. In terms of how things are playing out across the sectors then, we can take a look at the GRR function. It was technology that was leading the pack yesterday. Your two US 10-year yields, by the way, currently at 141, so comfortably still below that 150 level. The trajectory for the US 10-year and yields more generally, of course, crucial to those growth stocks. The US futures are pointing marginally just by 3 points after being lower a couple of hours ago. So a bit of a turnaround in the S&P futures after from heavy selling yesterday. Gold is now above $1,800 per ounce. BlackRock saying that maybe the yellow metal is going to get a bit of a bid in 2022 after having over the year to date, a soft year for gold. And the Turkish lira back in focus. You're seeing further losses of 2.6% for the Turkish lira. Again, another record low. You've got inflation in that nation of 21%, another cut to interest rates. That unusual monetary policy mix, of course, coming out of Turkey. Fran.
Unusual. It's so diplomatic. 16 to the dollar. You can't believe it. I mean, if somebody had told you that a year ago, you probably wouldn't have believed it, because it took a while to also break that 14 psychological barrier. All right, this is what we're looking at for the sectors. Again, a lot of focus, of course, will be on some of the technology stocks. Not as heavy rich here in the UK, or certainly here in Europe that it is in the US. But energy down 1%. If you look at travel and leisure, there are some of the ones that are losing the most. Technology down 0.6%. So you can see a little bit of a mixed picture. Financials also on the way down, and overall the European stocks down 0.1%, Tom.
So that's the turnaround that we're seeing broadly across these markets on an individual stock basis. We want to pull out some of those to focus in for you. Airbus Another deal in less than 24 hours, a big one with KLM Air France worth about 10 billion, at least at the sticker price. There will be the usual deductions, but this follows the deal that Airbus struck with Qantas as well. Both those airlines switching up their Boeings for Airbus. So a big coup for the airplane maker there, based, of course, in France. Gains of 0.2%. Ftse Micro, pulled this one out for you as well because of the pressure that we saw on Apple and the semiconductor space overnight stateside. Apple bringing some of that semiconductor making in-house. Bloomberg Intelligence says it'll be about 2 to 3 years before they can switch up the suppliers. Ftse Micro down 1.3%. And Stellantis as well. This is interesting in terms of shaping up, reshaping, restructuring the finance for autos on a day when you had a 17% drop in terms of auto registrations in Europe for November, the 5th straight month. Stellantis teaming up with some of the lenders across the Eurozone to restructure financing in that space. Currently down 0.8%.
So, Stoxx 600 opening lower this morning after central bank decisions over the last few days. Some of the world's most high-profile policymakers actually weighed in on the inflation debate.
And the economy is so much stronger now, so much closer to full employment. Inflation is running well above target.
Inflation is expected to remain elevated in the near term, but should ease in the course of next year.
There are signs now of more persistent price pressures, and that is a concern to us.
It is very unlikely that we will raise interest rates in the year 2022.
We are phasing out our purchases more rapidly because with elevated inflation pressures and a rapidly strengthening labor market, the economy no longer needs increasing amounts of policy support.
Okay, let's get into the key market drivers with our markets editor, Christine Aquino. Good morning, Christine. Always good to have you on air, of course, with us to break down these market movements. How should we be assessing the about turn in these markets, given the gains that we saw straight off the back of this announcement by Jay Powell and those gains being wiped out overnight?
Well, Tom, it's very interesting changes in price action over the last 24 hours, right? And I think we really can pin it to the fact that it's not just the Fed now that's moving toward a hawkish tilt. This looks to be a concerted effort from the world's major central banks. We have the ECB in there, we have the BOE in there. Granted, the ECB was relatively still less hawkish than you would compare it to the BOE and the Fed, but even there, the markets really had some hawkish nuggets to take away from that meeting, because Lagarde was flagging some upside risks to their inflation outlook. And so they were saying that even though their outlook for inflation is for it to moderate beyond 2022, there's very much a risk that those be to the upside. And so I think the message from central banks generally is that they're very much concerned about inflation, and that's definitely feeding through to market price action. Very much what's behind the back foot price action that we're seeing in tech stocks this morning.
Christine, we also want to bring up a wonderful Bloomberg chart, and this is thanks to Valerie, who noticed, the divergence. And basically, you're right that they're all dealing with inflation, but in terms of the policy mix, they're just dealing with it in a very different way. Although the economies, of course, are different. If you look at the ECB, the Fed, and the BOE, just the way they're thinking about inflation going forward is a little bit different. What does that mean for divergence in terms of currencies or just how you play the assets?
Well, it's going to be an interesting path for currencies and rate expectations definitely into the first quarter of 2022. As we can see from this chart, I think we have the most priced for the Bank of England. And immediately after yesterday's surprise rate hike, economists and traders alike both moved to price more rate hikes coming. I think immediately we saw pricing for nearly 25 basis points of rate hikes at the February meeting. So that's going to be the next time that the Bank of England meets. That's also going to be their first meeting for 2022. And we're seeing a bit more getting built out for the rest of 2022. In contrast, it's very interesting that in the aftermath of the Fed decision, there wasn't really a lot of a move to price in those 3 rate hikes that Jay Powell flagged. And it's potentially interesting contrast with how markets are taking it. Perhaps that they're not quite believing Powell's message just yet, that the Fed is going to have to or will have room to do as much tightening as Powell flagged during the Fed rate press conference. And so markets have been a little bit slower to price in those rate hikes. And of course, at the rear, the ECB expectations, once again, they were very clear that it's very unlikely for rates to rise in 2022. But again, given that they also flagged upside inflation risks, there's a lot of room for markets to catch up there.
Yeah, currently the US 10-year yield just edging up slightly, but still capped, it seems, at around 142. I have to question when that grind higher is going to happen for US yields. Bloomberg's Christina Kino, thank you. In terms of redhead crossing the terminal right now, this is interesting in light of the fact that the Europeans have failed to come up with a consensus on how to deal with these very high gas prices. Europe gas futures, this is the redhead, falling as much as 16%, falling as much as 16% to 120 euros 60 per megawatt hour. On ICE. Now, this is apparently back on the back of the Russians actually increasing supply at the last minute to Europe. So that is on the back of an increase in supply from Russia to Europe. We'll get more details on this story as and when it comes through. But gas futures here in Europe falling on the back of that news, Fran.
Yeah, and that has huge implications, of course, for central banks. When how they look at inflation, it also has huge implications for the trends going forward in revenue for a lot of companies and, of course, consumers. Coming up, it's been one of the biggest weeks for central bank decisions. That continues as some of them bet inflation is a bigger risk than Omicron. We delve into the decisions shortly. This is Bloomberg.
What do we know and what don't we know? Because there's a lot of speculation, a lot of anecdotes circulating right now.
Omicron definitely has the characteristics to create us concern for many reasons. But also we have been preparing for a moment like that for months right now. And I feel comfortable that the playbook will work. So what is the playbook? One, it is to understand more about this virus. The second, of course, will be to protect against infections. And the third is to treat. Let's take it one after the other to understand. I think there are a few things that are not very clear yet with Omicron. One, it is the clinical manifestation of this new variant. Is it creating more severe disease or not? Is it transmitted easier or not? Is it going to younger or older people? All of these are things that as we see clinical cases coming out and the numbers are getting bigger, that's something that we will know in a few weeks.
How will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap in between people that were worried about climate and people that were taking action.
Welcome back to the Open, everyone. 12 minutes into the European trading session. You can see we're seeing a little bit of sentiment taking a hit overall. This is on the back of tightening monetary policy to fight inflation and growth risks back at the forefront from the Omicron virus variant. Again, we had some leading central banks making a pretty big call this week. And for the moment, we saw a tech sell-off in the US, which is filtering through a little bit of pressure in Europe. So it's time to digest some of the decisions made in a big week for central banks. It's been one of the biggest weeks in a while. We have our reporter standing by for the latest on those decisions yesterday. Lizzie Burden here in London on the Bank of England, Jana Rando in Frankfurt on the ECB. Now, if we look forward, Lizzie, what we heard from the Bank of England is surprising the markets, but actually it feels like the markets took it in their stride, saying they'll adjust quite slowly in the future.
Yeah, I've had lots of emails this morning from economists who called the decision wrong and are now accusing the Bank of England of a communications crisis. But if you look back through what the governor and the MPC have been saying over the past 6 weeks, the governor did say that the bank was going to focus on inflation more than growth. That's its mandate, and that interest rates might have to rise to do that. Well, we had that CPI print on Wednesday, 5.1%, tipping past the 5% mark much sooner than the bank had expected. They also wanted strong labour market data. You had that on Tuesday. And crucially, multiple MPC members had said that they were focused on the medium term. Well, if yesterday's decision was about inflation versus Omicron, inflation's the medium term risk. And clearly the Bank of England has decided that it's going to live with the economic disruption in the short term of COVID. That's what's changed.
Lizzie, is the February meeting going to be in play as well? Because it's going to be at a time, if you look back at previous waves, where we're going to get the full extent, it seems, of the impact of Omicron come February. Is there a chance that maybe they stay pat in February, or is the market now pricing in another 15 basis points?
Markets are seeing February. Economists are a bit more cautious as usual. Bloomberg Economics expects a 25 basis point hike in May, and then another hike in November and another one in February.
Lizzie, thank you so much. Jana, the ECB wasn't as hawkish. What were the main key takeaways, and what does it mean for 2022?
Right. The president, Madame Lagarde, was very clear to say that interest rate hikes are still very unlikely next year. But what they said was that inflation and growth have made enough progress to allow for a gradual reduction in asset purchases over the coming months. So what will happen will be a slowdown in the pandemic program in the first quarter, and purchases under that program will come to an end in March as planned. To soften the blow a little bit on the market and to make sure that there are no disruptions, no financial tightening that the ECB is trying to avoid. They took a few measures, including an extension of the reinvestment under the pandemic program. And they also decided on a temporary increase of the APP. So purchases under that program, the regular program that has been in place since 2015, will be increased in the second and the third quarter. But come the fourth quarter of next year, those purchases will go back to the 20 billion we've seen over the past months.
Okay, thank you to Jana there. Jana Randa, of course, breaking down the ECB decision from us out of Frankfurt. Lizzie Burden here in the studio on all things BOE. Joining us now is Alberto Tocchio, Portfolio Manager and Head of Mutual Funds at Kairos Partners. Alberto, thank you for joining us this morning. Let's start then with the ECB. The message I took from Christine Lagarde was that they are giving themselves as much optionality as possible as they weigh up the Omicron and the inflation, the new inflation forecasts. What are the implications for European equities on the back of this optionality that the ECB is engineering into its response?
Yeah, first of all, I think we have to say that the market was expecting this kind of reaction. The only surprise was coming from the Bank of England. The bigger point is that we've seen a concerted okay message by the three major central banks over the last 48 hours. So the tightening has started. It is mild, predictable, but it has started. And the market, of course, are getting more volatile. Also importantly today, there is the most important expiry of the year, the famous quadruple bridge. So I think at the end it's not so surprising, it's not outrageous, but we have to consider that for next year there will be more volatility for the equity market.
Yeah. But Alberto, going back to the ECB and to Tom's very good question, I mean, they seem to act because they want to make sure that they don't, avoid some kind of brutal transition as they exit out of crisis mode. Are you comfortable with the fact that they will manage the economy, manage market expectations, and look through Omicron in a way that will actually be stable?
Yeah, well, the big point is about inflation because the temporary term has been removed by everybody. The ECB seems more comfortable than the Bank of England and the Fed for the moment. But of course, the macro data we are getting are quite strong and they're here to stay, at least for the first part of next year. So I think this is the main question mark for next year because based on inflation, central bank will adjust their message. Omicron is another point which is important now because we have seen how it's spreading in Europe and how it will eventually spread later on in US, I guess. So it is definitely a big question mark in the short term. But I think if we're looking more into the medium long term, Omicron is not the issue. So the main issue is the inflation and central banks will need to adapt to this.
Alberto, what is the market implications of this divergence that we're seeing, particularly between the Fed and ECB? Which assets are most sensitive to that?
Well, first of all, I think US has done extremely well this year in terms of equities, and they might get more volatile. And also the composition of the US indexes is more towards a growth or a high valuation names. So we've seen yesterday, for example, that for the first time in a while, Apple and Tesla were down quite a bit. So this is a sign to me that something might change for the next weeks or months. While Europe, at the end of the day, is supported by a still very dovish central bank, and eventually might get some interest from global investors.
Alberto, we'll go back to some of your big calls, your bold calls on some of the technology stocks. But look, the Bank of England, as you rightly said, was the big surprise yesterday. Does it make you more likely to get into UK assets or less likely? I don't know. Half the people that got it right saying, well, this is just the Bank of England trying to follow data and markets need to do their homework. And the ones that got the decision wrong saying, it's a communication problem for the Bank of England. So how did you view this?
Well, I think the fact that the Bank of England has removed part of the emergency cut it did last year, because at the end of the day, we just increased by 15 bips to the 60 bips of the emergency cut rate we had last year, to me is not a big change in the scenario. But of course, the UK stocks have been performed quite poorly this year, so I think eventually it will be quite nice to invest in the UK next year. Again, in the short term, we've got these big question marks from the Omicron. We know the spread in what's happening in London and the UK. So I would suggest to stay put for the moment, but eventually with the next year, to start investing back in the UK for sure.
Okay, Alberto on the call in terms of the opportunity in the UK next year as we watch, of course, the spread of Omicron. Alberto Tocchio, portfolio manager and head of mutual funds at Kairos Partners, stays with us. Coming up, Barclays, Goldman Sachs, JP Morgan, all plan to boost bonuses as banks seek to gain an edge in the deal boom. We'll find out who's been getting the big paydays next. This is Bloomberg.
To cut emissions, climate-proofing transportation is at the top of the list. 20% of global CO2 emissions come from transportation. 75% of transport emissions come from road travel. And 45% of road travel emissions come from passenger vehicles. 29.4% of road travel emissions come from freight. Of the world's transportation emissions, 11.6% comes from aviation, 10.6% comes from shipping, and 1% comes from train travel.
Welcome back to the Open. We are 22, almost 23 minutes into the European trading day. Of course, it was a handoff from the US, heavy losses across the NASDAQ, big tech, of course. In terms of what we're seeing here in Europe, losses, I should say, losses of around 0.3%. The one index that is standing out with some very modest gains is the UK, the Ftse 100 gaining around 0.2%. You've got autos in focus on the back of lower registrations dropping in November by 17% again. Energy in focus again, energy prices falling, and banks as well, lower by 0.4%. The US 10-year yield currently at 1.42. Let's get to another corporate story linked to what's happening in the banking sector. Barclays has become the latest big bank to put in place plans to boost bonuses. Smiles all around, maybe. It follows similar moves by Goldman Sachs, JP Morgan, as they all vie to gain a competitive edge in the tighter labour market. Still with us is Alberto Tocchio, portfolio manager and head of mutual funds at Kairos Partners. Alberto, the need to hold on to talent within the banking sector has been acute over the last 12 months or so. How do you read what's happening in terms of the bonus payouts and whether the banking sector is going to be able to maintain the edge in terms of talent and employees as they look maybe to an environment of higher yields?
Yeah, well, it is a very difficult topic because the environment is not great for salaries and everything, so it's difficult to talk about bonuses in general. But of course, we know that the investment sector is made by people, so you have to keep the talent, as you said, and the only way to do it is to pay people. So at the end of the day, if they're making some returns, and they will eventually do better even next year, I guess, because with interest rates keeping this pace or even higher, banks should do quite well. I think they will be able to pay people quite nicely, actually.
Yeah, but then you get into a bidding war, Alberto. I don't know what that means for, mutual funds, or whether there's actually inflationary pressure that then feeds into what central banks could do.
Well, on our side, I have to say that the salaries are different. We get paid on performance, so we have to only make performance, and we react, of course, to investment decision. I think for next year, equity is still the asset class to be invested. So eventually, even in Europe, we should do quite well, I guess.
Okay, Alberto, I want to get your contrarian call because this jumped out to me from your notes. You suggest that maybe, if you're feeling pretty risk on, you might want to be looking at buying some reopening stocks at this point. Just unpack that call for us.
Yes, of course. It's a very nice and contrarian story, as you said. At the moment, you cannot talk about a reopening because actually we might get towards some closures, local closure. I don't think we get back to what we seen last year with heavy lockdowns, but for sure there will be some local closure, local restriction, as we've seen over the last couple of days in Europe for traveling. So it is not the right moment to start investing again, but stocks have been already pricing this. So most of the stocks, they've dropped by 10, 50%. And I believe that eventually at some point in January or February, we will start to get some positive news with contagions coming down. And eventually will be the right moment to play what will be the big theme for next year. So I think next year, these stocks should do quite well.
Alberto, thank you so much. Alberto Tocchio, their portfolio manager and head of mutual funds at Cairo Partners. Also have great holidays. I feel like we can say it a week before Christmas and the holiday season. I'm so not ready. I kind of don't have anything ready. So let's move on. Let's move it to June 2025. Coming up, humiliating defeat. The Tories lose a previously safe seat in a by-election. So we look into what that means for the Prime Minister Boris Johnson. That's coming up shortly. And this is Bloomberg.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the Open, everyone. 30 minutes into the European trading den, here are your top stories. Central bank divergence. While the Fed and the BOE see inflation as a main threat, Lagarde's ECB sticks to its pandemic-era monetary policy. Turning up the heat, the U.S. pushes EU allies for broader sanctions against Russia as the bloc fails to agree on a solution to its gas crisis. And the lira tumbles to a fresh record low. The Turkish central bank cut its key rate and says it's ending its easing cycle. Tom, I have to say I'm a little bit lira obsessed because now it's 16 to the dollar, which is huge. And overall, we look at technology stocks putting pressure on European stocks.
The technology sector is fascinating, isn't it? You're whipsawed if you're an investor in that space. There's NASDAQ down, up again, down again. Investors trying to get to grips with what this is going to do in terms of the tighter environment from central banks and those yields grinding higher, although they are still capped to what, like 142 for the US 10-year. How that's going to play out for the tech sector. Maybe you need to be more focused on drilling down. So those with the big balance sheets, maybe they can weather this, and the non-profitable parts of the tech sector maybe are set up for some more vulnerability. In terms of how things are playing out across Europe, 30 minutes into the trading session, the futures have pointed in the early part of the session to losses of 0.4–5%. That's not what's happened. It's a little bit more muted, down about just over 1/10%, less than 1 point across the benchmark. And it's a divergent picture as well across these indexes. The DAX is down 0.2%. What you're seeing in the CAC 40 are very modest gains. Airbus is a factor there after striking a pretty sizable deal worth about $10 billion, at least on the top line, with KLM Air France. The FTSE 100 gaining 0.3%. Basic resources, a bit of upside there. The auto sector is interesting as well today, given that for November, you saw a drop of 17%, the fifth straight month in terms of European car registrations. That's the biggest drop, by the way, since records started in 1993. Let's switch it on and see how things are breaking out in terms of the sectors then this Friday morning, 1 week from the start of those holidays when it comes to Christmas. Retail gaining 0.5%. Real estate is in there as well, as is basic resources. Just very, very modest gains in these sectors. At the bottom of the list, in terms of the losses, it is autos and parts. Not a big surprise, given the data that we saw weighing on that sector. It's a demand question. It's a supply chains picture as well. Energy prices, energy sectors down about 1%. You've got gas prices coming off on the back of a surprise addition of gas supplies by Russia to the European markets. And technology is lower by 0.6%. Fran.
Now, UK retail sales, Tom, surged more than expected last month as Black Friday discounts drew consumers back into the shops. The figures shed light on the strength of consumer spending before the Omicron variant struck. Rain Newton-Smith, CBI's chief economist, now joins us. Rain, thank you so much for being with us today. We're trying to figure out some of the political ramification, Omicron, some of the soft, if not lockdown, certainly people not going out to shop. How much will Omicron cost the UK economy?
I think it's hard to say at the moment because we just don't know how severe this latest wave will be. But I think what we do know is a few things. First of all, the economy is in a much better state. Businesses are much more resilient to learning to live with the virus than we were a year ago. So it's not a return to some of the really previously stringent lockdowns and the impact on the economy. But I think what we also know is actually it is having a devastating impact on some sectors and some businesses. So if you're operating a gym in a city center, if you are a high street shop in a city center, if you are a live event business, if you're pubs, the airline industry obviously is really being impacted from some of the travel bans that we're seeing at the moment. So our message really to the government is we need to see some targeted cash flow support to some of these businesses where living with this virus is going to be tougher for longer.
So there are those measures that you've outlined that the government should step in with to support these businesses. Labour supply is one that's been a long-running issue now for UK businesses as a result, of course, of the pandemic, but also Brexit. That is a more difficult problem to address.
Yeah, it is really challenging. And it's also why, I think the decisions for policymakers right now are tougher than they have been for a while. And we saw the Bank of England tightening interest rates. That's because we're seeing supply chain pressures turning into inflation. And we are seeing stronger wage inflation and much more tightness in the labor market. And so that's one of the reasons why we've seen the Bank of England take some action. I think over the longer term, the only way we will solve our skills shortages here in the UK, of course, is focusing on training, on those longer pieces around how we sort of upskill people for the world of work. But I have to say, it's better to have this issue now where we have low unemployment, high vacancy rates, rather than what we thought we might have had a year ago with, the potential for unemployment being in double digits. And I think it does mean that now some of those, a return to a job retention scheme open to all businesses doesn't feel like the right measure to support the economy. I think we have to have really targeted support at some of those businesses who are really in the crosshairs of this latest wave of the virus.
Rain, with interest rates going up, of course, with the Bank of England, that surprise announcement yesterday with Omicron, is there a danger that a lot of businesses will actually go under? I don't know whether we're looking at zombie companies or just, businesses that won't make it.
So I think there's sort of two things there. The Bank of England decision is really about, a very small, we have to remember it's only 15 basis points. We're still looking at interest rates at 0.25 basis points. Long-term interest rates are still at all-time lows. So I think it will obviously have an impact on slowing some demand. It increases the cost of mortgages for some people who have variable rate mortgages. It has an impact on the short-term cost of borrowing. But I have to say, over the longer term, interest rates are still very low. So I don't think we're going to see a big impact on wider growth. But I think it was an important signal by the Bank of England that they are prepared to act. We have to recognize inflation now is over 5%. They expect it to peak over 6%. And I think it is really important that the Bank of England say they are going to act on the inflationary pressures that we see. And of course, the decisions they're making now are also looking at the future prospects where pressures in the economy will be in 12 months' time.
Yeah, and some of those pressures, you touched on the supply chains. What are your members telling you? What is the data telling you about where we are in terms of those supply chain snarls and whether we've started to overcome them, the adaptability of business as well?
So look, I think we've seen a huge amount of innovation and resilience in businesses and, of course, in all of us as individuals over the past year and a half. And some of that will absolutely carry us through what will be a very intense, but hopefully very short-lived spike in infections that we're really seeing here in the UK at the moment. But I think, businesses have definitely adapted to what we're seeing, but that doesn't mean that for some businesses, the pressure is very acute, as I was talking about those sectors in particular.
Rain, how difficult is it to find workers? I mean, one of the things that you go into a restaurant and a lot of them, even the high-end restaurants, saying they only can do one service instead of two because there's a shortage of people that, can come from the European Union or elsewhere. Will that continue well into 2022?
Yeah, so actually picking up on 2 points and where we're seeing some of the supply chain shortages. I think what we're seeing is definitely a shortage in semiconductors. That's one area which is expected to persist, and that's having an impact as well on the supply of cars. And I think, and also we've seen very high shipping costs. Now, some of that seems to be easing and maybe coming down, but everyone is holding their breath when we're seeing this latest wave of the virus. And one of the things the Bank of England pointed out is, it could make those supply chain shortages worse. And that's one of the reasons why they acted. I think when you're talking about the availability of people, I mean, we've all seen it. My local cafe, even a month ago had a sign up saying we can't do in-store service today. There'll be no sit-in service because we just can't find people to open our cafe. So I think that availability of people as businesses are trying to open up has been one of the big challenges over the last weeks. I think now we're facing a different challenge, right? Because the infection rate is so high. Let's hope that it's a milder variant. There's some indications it is, but it does mean there's a huge amount of people self-isolate. And I think that's actually where we're going to see the biggest challenge for the economy over the next couple of weeks is the lack of people who are self-isolating. And that's why I think it's really important we use testing. Everyone goes out and gets their booster, as I did yesterday, to really help and contain this virus.
We're running out of time, but great perspectives as ever on the impacts of Omicron across the UK economy, of course, the implications as well of tighter monetary policy from the BOE. That is Rain Newton-Smith, the CBI's chief economist. Have a great weekend. Thank you. Let's get the first word now with Angel Feliciano.
Tom, Boris Johnson has suffered a political upset, losing a key parliamentary election. The Liberal Democrats took the previously safe Conservative district of North Shropshire with a majority of nearly 6,000 in a special election after a lobby scandal. At the previous election, the Prime Minister's party won the rural seat in the West Midlands with more than 62% of votes. The UK has reported more than 88,000 new positive COVID tests, a second consecutive day of record-breaking infections, underlining the spread of the Omicron variant. Data show almost half of workers in the City of London didn't go to the office on Monday, the fewest since September. New York City's health commissioner, meanwhile, says COVID-19 numbers show an alarming trend in infections. U.S. health officials are backing the use of Pfizer and Moderna's vaccine over Johnson & Johnson's shot. A panel of experts told the CDC voted unanimously to make the recommendation for adults. This after U.S. regulators announced revisions to the J&J vaccine fact sheet to warn of links to a rare clotting syndrome. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom.
Angel, thank you so much. I'm going to pick it up because we're going to digress. So much love for this picture on so many levels. Carrie Bradshaw, I know she's been in the news for other things. A lot of people very angry. We're not going to give spoilers away. And Tom just looks puzzled. But look at this. She's using the Bloomberg terminal.
I was a fan of Sex and the City back in the day. I don't know about the film.
We're all a fan. And, you know, she's come back. And the funniest thing is from one of our producers saying, now we know finally how she can afford that nice apartment in New York City. Way to go, Carrie Bradshaw.
Thanks to the
Bloomberg terminal.
Thanks to the Bloomberg
I feel
terminal.
vindicated.
So I think they've shown it, definitely had it in billions as well. We were there in billions. I'm pretty sure we see the terminal popping up in succession. I don't know if you've got into that series. Phenomenal.
I haven't, but nothing beats Carrie Bradshaw with the terminal. Coming up, European leaders have warned of massive consequences for Russia if it were to invade Ukraine. The potential disruption of global markets for energy could prove problematic. More on that next. This is Bloomberg.
Front, when your shares are down 20%, it's going to hurt. But talk to us about, well, really what you're seeing. Take us forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution, fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Happy holidays from all of us at Bloomberg.
Welcome back to the Open. 44 minutes into the European trading day. The about turn in these markets being reflected in what we're seeing across the European stocks benchmark. Down 0.4%. The Ftse 100 is the standout, gaining 0.2%. The politics and central bank action of the UK front and centre. The Tory party taking a big blow in terms of a by-election defeat here, and the BOE raising rates. In terms of your sectors, retail at the top of the list, but it is broadly losses that you're seeing. Autos firmly at the bottom, down 1.4% on the back of November registrations falling 17% for the fifth straight month. Let's switch focus to what's happening in terms of the geopolitics and energy prices now. Russian troops are still gathered near the Ukrainian border. The Biden administration is pushing its European allies to finalize a broad package of sanctions against Russian banks and energy companies should the Kremlin invade. But with about 40% of Europe's gas imported from Russia, the potential disruption of global energy markets could prove problematic.
It's of great importance to all of us here that Europe's borders are not moved, that everyone exists in security.
We maintain our call on Russia to de-escalate tensions and refrain from any further aggression. We would like to be in a situation where relations with Russia are good, but this is very much depending on the choices made by Moscow.
We had an important discussion with President Zelensky, and we have very clearly reaffirmed our attachment to the Normandy format, also together with Russia.
We have agreed that if there is a military aggression against Ukraine, consequences would be massive. We are disposed to coordinate concrete and operational measures together with all of our allies.
Now, for more, we go to our European correspondent, Maria Tadeo, live in Brussels. Maria, good morning. So Europe now warning of massive consequences. What could those entail, and would they come jointly with the U.S.?
Yes, Francine, and yesterday, that language, that statement, that clip that we saw right there when the head of the European Council said the consequences for Russia would be massive, they would be immense, and the economic damage that the country would also suffer would be very significant. I mean, this is a kind of language that we hadn't really seen until now. It is worth noting, Francine, that yesterday, European leaders met behind closed doors for more than 2 hours, debating the situation in Ukraine. The Ukrainian Prime Minister Zelensky was here 2 days ago. There were no phones in that discussion. That's when you know it's a very heated, it's a very delicate issue. Of course, they don't want to be hacked and they don't want to have leaks on that. The question is, as you mentioned, what type of sanctions could we see? Now, the European Union yesterday was very cautious about that. They did not go into specifics about companies or sectors, but the head of the European Commission did say we have a list and we could put that ready to work. It's a very clear message to Russia that if they do this, there will be very severe consequences. The other thing, Francine, that also feeds into this conversation is that we now know that the Nord Stream pipeline is probably not going to be certified by the German regulator in the first half of 2022. So that is still a story that plays into the German government. But as you see, there is no rush to approve this.
We're seeing gas prices, European gas prices falling today on the back of additional supply from Russia. This was a topic that was discussed as well. What did we hear from European leaders on this issue?
Yes, and again, you know, Vladimir Putin has been very careful to keep supply very tight, but also not be in breach of contract through Gazprom. And he's always been reminded about that by European leaders. And yesterday, of course, energy prices featured highly on the agenda. European leaders are expecting prices to continue to be high in the medium term, but there was no agreement over joint solutions. Again, we're waiting for a big European solution. That did not come through, but we did get a big debate once again about nuclear energy and the type of role that we should get. And it's interesting, Tom, because today I spoke with Thierry Breton. He's the commissioner for the internal market. He spoke to us exclusively, and I asked him flat out, do we have nuclear energy, yes or no? And this is what he had to say.
In order to achieve our Green Deal and the zero CO2 emission by 2050, we will need nuclear energy.
And that was Thierry Breton speaking to us in the European Market Open. It is worth noting, however, that he was appointed by Emmanuel Macron. The two of them are French, and the two of them have doubled down on nuclear energy. But it's not just the French. Yesterday, the Dutch announced that in the new government led by Mark Rutte, they will also increase their investments on nuclear energy. Francine.
Thank you so much, our Europe reporter there, Maria Tadeo, joining us on all of these gas concerns. Now, coming up, European car sales continue their slump. We'll focus on the auto sector next. This is Bloomberg.
Good morning, traders. Please place your order to sell short euro. The price, I'm going to sell 113.32.5. Okay. Order placed at 113.32.5. Okay, you got the strategy. Please place your order and stay with me, and we will close this trade. It probably won't be, hopefully we will fill this trade. Let's see. If not, we will enter later on. We will see what's going to happen. Okay. I'll speak to you later, guys.
The world's urban areas are most vulnerable to climate change. Cities consume 78% of the world's energy, while also generating 60% of greenhouse gas emissions. By the year 2100, 85% of the world's population is expected to live in cities. 90% of all urban areas are coastal. And with sea levels rising, 800 million residents are likely to be affected. 1.9 degrees to 4.4 degrees Celsius is the projected increase in urban temperatures around the world by year 2100. By 2050, 1.6 billion people are projected to be vulnerable to chronic extreme heat.
Okay, guys, well done. Position open, short position at 113.32.5. Okay, stay with me. We will close this trade together. Okay, well done, guys. All of you who decided to follow this trade, stay with me, and we will see how far it will go and how much profit we will make. Okay, stay safe.
Autos, the biggest loser overall, and banks. Now, this is also on concern of what we heard yesterday from central banks. Yesterday, the market was pretty cool about the fact that we saw adjustment because of inflation. Today, they seem to be either taking a bit of profit or actually worrying about the economy. We did see a bit of pressure on technology stocks overall. Now, Europe's auto market shrank for a fifth consecutive month with record low registrations for November, reflecting how slowly the industry is coming back from the depths of a supply crisis. New vehicle sales fell 17% to the worst showing for the month since the European Automobile Manufacturers Association started tracking figures back in 1993. Some of us remember that. Most don't. Joining us now is our global car czar. He is Craig Trudell. So, Craig, first of all, give us a sense of the supply chain issues. A lot of companies saying they should get better in 2022. What does that mean for how much they can ramp up production?
Yeah, I think we heard just over and over again the latest round of earnings that, you know, the worst is behind us, the worst is behind us. But I think in the same breath, what we've heard from the executives is that they are not expecting for any sort of, you know, quick recovery in supplies of chips. And that's been obviously the sort of inhibiting factor for the industry all year. the expectation just being that it's going to take quite a bit of time for more capacity to come online, and also that the semiconductors that the auto industry is used to procuring, they're these sort of older ones that the chip companies are in no hurry to boost capacity for. They want to sort of, move into the sort of next generation of chips. And so you have a situation where while the industry is trying to shake up their supply strategies, work out some procurement deals, this is not going to be a sort of quick and easy fix. We're going to be in this well into next year and potentially for years to come.
In this for the long haul. In terms of what we're seeing in the EV space, Craig, there was one company that stood out yesterday, of course, Rivian. Its first set of earnings, it missed expectations and the stock got hammered. But more broadly, the EV sector is a space that is doing okay, it's holding up.
Yeah, absolutely. And actually here in Europe, I think that is a big story of this past month, where while the industry had a really rough go of it, electric vehicles are doing really well. I think it's a situation where the industry knows that they need to manage the emissions across their fleet. They are in a situation where they're capacity constrained. They can make some decisions about what they can and can't make. And there is demand on the other end here in terms of the amount of electric vehicles that Volkswagen and Stellantis and some of the major car makers are selling. Tesla also having a really good year, in part because of China, actually. A lot of imports of vehicles from Shanghai. That's been a major story for them this year, their ability to expand in this market because they have more supply to work with because of that second assembly plant, to send cars this way.
Craig, I can't let you go before asking about Elon Musk. He sold another batch of Tesla shares. Is this even news? Do we just assume that he's actually selling off shares to the point that he promised on Twitter?
I'm just counting down the days when this is all over. I think we're about 3/4 of the way there. So hopefully it's something that we won't continue to have to talk about into 2022. I'm sure he'll give us other storylines to work with.
All right, Craig Jadel, our Tsar on all things autos there. The registration's falling. And, of course, on Tesla. Talking of Tesla, over 5 years, you got a 2,000% gain. Crocs, this is a surprise, 1,900%, 1,900% gain in about the same period. So Crocs almost up there with Tesla in terms of the market run.
I mean, I just can't believe it. I still don't know one person that admits to wearing Crocs. So you find me one person.
We'll find one in the newsroom, I'm sure. The markets here across Europe, you're looking at losses of 0.4%. The futures are now pointing lower stateside. That is it for the European market open. Surveillance, early edition is up next. Happy weekend. This is Bloomberg.
When you talk about the commercial viability, the idea that these companies can actually make money off of this here, does this become, I guess, something that's niche in the sense that you have to pay several $100,000s to do it, or does it come back down to a level where just regular folks like you and me will somehow find a way to be able to take a trip up, and this can be a business model that will be sustained?
I think it's important to note that space tourism is a small segment of the overall global space economy. Space tourism accounts for $1 billion of a global $350 billion global space economy.
What's the rest of it?
$260 billion of that is satellites, manufacturing them, launching them, And these satellites we use in our everyday lives, whether that's to listen to the radio, to watch Bloomberg on our satellite television, or to navigate us to our destination via GPS. And I hope in the near-term future, we will add getting our internet from space.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Inflation is running well above target, and growth is well above potential.
And there are signs now of more persistent price pressures.
It is very unlikely that we will raise interest rates in the year 2022.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Central bank divergence. While the Fed and the BOE see inflation as the main threat, Lagarde's ECB sticks to its pandemic-era monetary policy. Also, turning up the heat, the U.S. pushes the EU allies for broader sanctions against Russia as the bloc fails to agree on a solution to its gas crisis. And the lira tumbles to a record low. The Turkish central bank cuts its key rate and says it's ending its easing cycle. So a lot of focus, of course, on the markets. We did see a sell-off that started off with technology stocks in the U.S. We're still seeing quite a lot of pressure here in Europe. Banks also on the way down some 1.4%. Overall, if you look at the European stock 600, down 0.4%. Now, the picture is they're looking at what we heard from central banks yesterday on inflation and why they're starting to normalize. Yesterday, there was a bit of an upside lift. Today, I guess they're wondering about divergence. There could also be a bit of profit taking just because it is the last working Friday before the holidays, and you can see the S&P 500 futures down some 0.1%. Look, the U.S. dollar Turkish lira is actually looking at some crazy moves. I know it's not a technical term crazy, but if you would have told me just 18 months ago that we would have touched to 16 per dollar, a lot of people wouldn't have believed you. Just moments ago or days ago, we touched 14, and that was a big psychological level. Now, let's make a difference with what we're seeing in the Ftse, but the Ftse MIB and the DAX. You can see the Ftse is actually holding on some gains. It was lower in the last 4 to 5 days compared to some of the other ones. The biggest loser in today's trading session, the Ftse MIB, dragged lower, but a lot of the banking stocks down 0.7%. Now, let's try to digest some of those central bank decisions in what has been a busy week for policymakers. We're joined by William de Wilder, Chief Economist at BNP Paribas, and Bloomberg's Christine Aquino. Thank you both for joining us. So, William, let me kick off with you. What was your main takeaway from all of the policy divergence that we heard from the Bank of England, the ECB, and of course the Fed? They have the same concerns. Of course, economies are a bit different, but actually the way they think about it is wildly different from one to the next.
Indeed, same concerns. I would say the same journey as well. The direction is the same. The speed is very different. And I would say what is striking is that you have a flexibility in terms of the approach that you observe in the US and in the UK as well. Whereas with respect to the ECB, the policy reaction function is very strict. There's very strict rules, in a way, self-imposed on what is required to contemplate a policy rate hike, and we are not there based on the projections. So in a way, the ECB is very consistent with its approach.
Let me also show you a chart, actually, that our Valerie put together for us, and it really shows, Christine, some of the divergence that we're seeing in terms of central bank policy. You look at the BOE, you look at the Fed, and of course the ECB, and I would add to that maybe the BOJ. It's going to be very, very different on how the currencies actually perform.
Absolutely, Francine, and I think that is going to be one big wild card heading into 2022 is how much of this is actually priced into markets at this point. You could argue because there's so much priced into the Bank of England rate expectations front, for example, there's probably some room for sterling to reprice that, for instance, if things don't go as well as expected when it comes to growth, when it comes to the Omicron situation and other potential variables for the UK economy. And then on the flip side, with not much priced in for the ECB, but at the same time, the ECB flagging upside risks to inflation, you have to wonder, is there more room for the euro to price in those expectations, especially if we get more evidence that inflation isn't quite as transitory as we would have been led to believe in Europe?
William, do you agree with that? And actually, are we underestimating the impact that Omicron or another variant could have on economy closures?
Well, first of all, I fully agree with what Christine has said. I think what's important to keep in mind is that the ECB will not hesitate to change its tone if it sees inflation higher for longer. Let's not forget that yesterday in the staff projections, there was a pretty significant upward revision for the inflation part for 2023 and then with the new forecast for 24. In the same way, we should not be surprised if it turns out, because of infections, Omicron and what have you, that the tone from the Fed and the BOE would evolve as well. So I think there is indeed a clear potential that we would be surprised, and that would then be a factor supportive for euro. I think in the very near term, the key issue that we are facing is what's going to happen with the infections. As we see, there are travel restrictions that are being introduced, and it gives us a very uncomfortable feeling for the near-term economic momentum, in particular in certain services sector. And that means that the first quarter of next year could actually be quite a bit more subdued. A major question that is related to that, of course, is this going to imply that you will have longer supply disruption and hence even more inflationary pressures being put? In that respect, the PMI flash data yesterday were bringing some comfort, a tiny bit, that some price pressures seem to be easing.
Where do you see, Christine, the biggest interest coming actually from the market? And I know we'll get on to some of the quirkier moves, but there seems to be quite a lot of maybe European bonds that we need to look at as well.
Yeah, absolutely, Francine, because I think, we saw a lot of investors trying to navigate the message from the ECB yesterday, especially with regards to the PEP program and what shape the APP is going to take once the PEP program ends, right? And initially, we saw, for instance, Greek bonds rallying quite a bit heading into the rate decision. I think there was some speculation that perhaps the APP program was going to be a little bit friendlier to Greek bonds once PEP ends. I think that rally faded a little bit once we got more specifics of the program, but I think it's going to be interesting to see how that all unfolds and how, the riskier parts of the European bond market will navigate this. Italian bond spreads also in the mix. That's, of course, a favorite gauge of risk in Europe, and I think the consensus there is for a little bit wider BTP bond spread heading into 2022 as well, as we do get a little bit of normalization from the ECB, even though it's not as fast as we would see, for instance, from the Fed or BOE.
William, what does a policy mistake actually look like from the ECB next year? It seems that they want to, message and manage the markets very carefully so that we don't have a kind of taper tantrum. Is there something that makes you worry about the path forward?
Well, the concern that I have for the euro area, and it would influence monetary policy, of course, is that you would have a tightening of financial conditions imported from the US. That's my real concern. Up until now, tapering in the US, no impact on markets whatsoever. Congratulations to the Fed. Hawkish tone, no market impact. Again, congratulations. Eventually, as we get into the second half of next year, we will be underway in a policy tightening cycle, market focusing on how many rate hikes in 2023. So that means more volatility on the S&P. Dollar should have strengthened normally. Corporate bond spreads should be widening, and part of that reduction in global risk appetite, which is manifested in what I've just described, would then actually spill over to the euro area. That means that, it could mean that for the ECB, it could actually be forced to hold off a little bit longer before envisaging a rate hike. Importantly, however, in the message yesterday is that the increase of the APP is only temporary. So I think what they're really already preparing is that later next year they will start with an announcement of tapering the APP.
Yeah. All right, thank you both. So William de Wilder there, Chief Economist at BNP Paribas, stays with us. Christina Keynote, thank you so much for all of the market insights. Now, we're also just getting some breaking news out of IFO. This is for the December German business confidence. It's quite telling because I think it just catches right at the beginning of Omicron, or maybe it misses it by a couple of days. I need to look at exactly of what we were looking at in December, but it's a little bit below expectations. So it does take into account the formation of the new government. So we have plenty to talk about when it comes to Germany. 94.7 instead of 95.3 we were expecting. Now, later this hour, we speak to the IFO president, Clemens Ftse. You can send in your questions on IB plus TV Go. This is Bloomberg.
Worker perspective, a recent headline, you got Kellogg's Cereal Union says the latest agreement that they had was rejected. Deere had to finally make a union contract. How concerned are you about the longshoreman contract and union negotiations right now?
Well, we're some time away from that. The contract expires on the 30th of June next year, and both sides have told me that they'll sit down to the table and begin negotiating in May. These are always important discussions, and usually when the spotlight is on our industry. But there'll be some issues around wages. The industry is making a lot of money. The longshore folks would like to see that. Now, I don't speak for either side, but training and development of the workforce will also be key as robotics and automation are front and center. The workers cannot be left behind.
Yeah, but to that point, I mean, do you feel like the balance, though, has shifted? I mean, for so long, workers had a lot less negotiating power. Do you feel like the pendulum's shifting?
The International Longshore and Warehouse Union, which does work across 29 West Coast ports, is very strong and a democratic organization.
To really keep in mind, vaccination is the first line of defense. And at the end of the day, whichever vaccine you take is going to be better than no vaccination.
So much stronger now, so much closer to full employment. Inflation is running well above target.
Inflation is expected to remain elevated in the near term, but should ease in the course of next year.
There are signs now of more persistent price pressures, and that is a concern to us.
It is very unlikely that we will raise interest rates in the year 2022.
We are phasing out our purchases more rapidly because with elevated inflation pressures and a rapidly strengthening labor market, the economy no longer needs increasing amounts of policy support.
Some of the highlights there from this week's central bank meetings. Now let's get back to William de Wilder. He's chief economist at BNP Paribas. William, we talked a little bit about some of the policy diversions that we're seeing across the world. We mentioned Omicron and some of the concerns, of course, as we go into the winter season. But, you know, your main takeaway for 2022, is there something that you think could go wrong that would actually really take us by surprise?
Well, the obvious candidate is that inflation lasting longer. And really that is based on the idea that you would have second round effects. It is striking to see the dynamics of wage increases in US, employment cost index, wage tracker. But even anecdotally in Europe, you also see that the pressure is on the rise. That, by the way, is actually good news because, after all, what we want in Europe that we would reach the inflation target. So that would be one candidate. The second candidate is that financial markets in the fall of next year would become obsessed about what is the impact of cumulative tightening by the Fed, including what is expected for 23. How is the economy going to digest that, and that you would have a kind of growth scare kicking in?
So, William, a growth scare that central banks could mishandle, is there a worry actually of policy adjustment right now?
Yeah. Well, as you know, the ambition of every single central banker in a policy tightening cycle is to achieve a soft landing. As Greenspan in the old days told us, soft landings are very hard to achieve. So I would say that if we would speak in 12 months' time, that is going to be the key question looking at 2023, will the US soft land? Now, in a way, it looks very premature to even talk about that, given how strong all the data look like and the fundamentals are really well-oriented. But I still think that with the tightening of the financial conditions and with rate hikes of the Fed, that is going to be an overriding concern. I think for that reason, what the Fed will do, I would expect, is that they will tread very cautiously. And the reason is that a policy mistake, of course. The cost of the policy mistake is very high if you have very limited policy leeway and to cut and ease afterwards. So that's why they do not want to make a mistake.
William, one of the other things that we're trying to figure out is, of course, some of these supply chain issues, and I don't know whether they stem for also transition to a newer economy or it's just because of Omicron. But how much will they ease? We're seeing supply shortages of a lot of semiconductors. There's also labor shortage because of a mismatch. Does this continue well into 2023?
Well, labor shortages probably will last for quite some time. When there is a cyclical dimension, there is also a health risk dimension in the sense that people being exposed cannot go out for work, have to take care of their children and whatever. I think another important point that you see is that there have been quite massive changes in how would you call it, preferences of people that have said, well, I can work in another sector and I do not want to work long and very odd hours. So some of these sectors are suffering from that. You see, again, anecdotally, wage negotiations in France, for instance, in the hotel and restaurant sector that are really pointing towards pretty significant increases. So that's on labor. I think on the supply chains, the problem is that in certain sectors, production is very inelastic, supply is inelastic. Think of semis. It will take 3 years before a new plant is up and available for working, for running. And so that's going to be an issue as well.
William, thank you so much for joining us. William de Wilder, their chief economist at BNP Paribas. Happy holidays. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine. Boris Johnson has suffered a political upset, losing a key parliamentary by-election. The Liberal Democrats took the previously safe Conservative seat of North Shropshire with a majority of nearly 6,000 in a special election after a lobbying scandal. At the previous election, the Prime Minister's party won the seat in the West Midlands with more than 62% of the votes. Now, Goldman Sachs says it cannot rule out oil at $100 a barrel in 2023. 2023. That is because supply additions are expected to be slow to keep up with demand. Goldman's base forecast is for Brent to stay around $85 over the next 2 years. The bank says consumption of gasoline, diesel and plastics could reach new highs in 2022. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, coming up, Germany's Ifo Business Climate Index for December falls a touch. We speak to the Ifo president, Clemens Ftse. If you have any questions for him, IB Plus TV Go. This is Bloomberg.
Years ago, this was the site of a bitter battle between India and China. 6 decades down the line, the two Asian giants are again engaged in a bitter border dispute. The 13th round of talks have ended in a stalemate. As the winters creep into the Himalayas, both sides have reinforced, and soldiers are hunkering down. India has reinforced its positions all along the line, bringing in additional troops, tanks, guns, UAVs. Clearly, neither side are taking any chances.
How fragile is the European energy complex?
The European energy complex has been incredibly fragile for a number of months now, and it just seems to just keep getting hit with new crises.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Germany's Ifo Business Climate Index for December has fallen as companies have lost confidence in the near-term economic outlook after resurgent coronavirus infections forced new restrictions and raised uncertainty. Well, joining us now is the Ifo Institute President Clemens Ftse. Mr. Ftse, I'm actually surprised that it didn't fall by, as much as it could have, because we were just at the beginning of the coronavirus. Is the threat of coronavirus and potential lockdowns being underestimated, or do you think the economy can look through it?
Well, I think that really depends on how this wave plays out. The difficulty is that we don't really know how bad Omicron will be and how severe the infection will be. It will spread quickly. And I think the worry is that there will be lockdowns also for vaccinated people. Currently, we have restrictions for unvaccinated people mostly, but the worry is clearly that this will need to be extended because hospitals are overcrowded. And I think that's the risk for the economy. Manufacturing will get through it better, but for services, for retail, this is a big problem.
Mr. Ftse, talk to me a little bit about what you're expecting for 2022. How much easier will the supply chain constraints be? Are you expecting it to be about the same, or will it get significantly better?
Well, what companies are telling us at the moment is that they do expect these things to improve in the coming months. In this survey, the share of companies telling us they have supply problems has risen even above 80%, which is bad. But at the same time, companies are telling us they do expect this to improve. So we would improve problems to remain in the first quarter, but then in the second and third quarter, we expect things to improve a lot. In manufacturing, all the books are full, so there is a potential for a strong recovery, probably starting in the second quarter.
What does it give you in terms of, labor shortages? This is one of the big things that we've been talking about. Are you expecting that to ease at all, and what are you expecting from the new government?
Well, labor shortages are not as bad in Germany as in the US, for instance, but they are there. Of course, they are holding back some investments and some production, but I don't think they are holding back the recovery at the moment because there is quite a lot of short-time work. The new government will try to address this more with medium-term measures like facilitating immigration, improving labor supply incentives. There are some issues in our tax and transfer system that prevent people from working. For instance, the taxation of couples reduces labor supply incentives mostly for second earners, which are women in the majority. So the government is aware of these issues and will do something about it.
What does that mean for inflationary pressures? And is the biggest, maybe risk to the recovery that the ECB will have to act quickly because this is, will end up higher than expected?
I wouldn't say this is the biggest risk. We have to see that people, especially in Germany, are concerned also about inflation, about rising prices, not just concerned about possible restrictions or rising interest rates. I think the ECB needs to strike a balance between not being a burden on the recovery and at the same time reining in inflation. It's very important. I think yesterday's decision was very dovish. So the ECB says inflation will essentially disappear in 2022 or fall below 2%. That is very optimistic. I think it would be wiser to communicate clearly that this may go wrong and that the ECB may have to act earlier.
Thank you so much. The IFO Institute President there, Clemens Ftse, joining us this morning. Coming up, from supply chains to cybercrime, we look at the political risks for next year. This is Bloomberg.
Guys, please place your stop for this position. We opened at 113.30.5. Okay, stop placed. So we secured our profit. If anything, basically anything can happen. You will not lose any. You will not lose money on this position. Okay, so let's color it into yellow color so people who just joined will understand what it is. Okay, and let's see, don't sell please. Let's see how far it will go. It will go even lower. We will increase our stop for our profit.
basically you don't have to call it stop loss because you are not losing any money from this trade. You're already in profit. In our case, we're in profit of £200 because 1 pip equals £100. We're already from 113.32.5 to 113.30.5. 2 pips equals £200. So we secure this profit. If it will go lower, we will increase our profit. So please do so for other people as well. For other people who don't have strategy yet, you need to go to company.co.uk and get the strategy. Practice for a couple of weeks, copy our trades. You will have to stay with us for a couple of weeks, and then you're on your own. Every time we give you live support for life, so you don't have to think that we will leave you on your own. If you will have any questions, you can always send us email. This staff is working hard to answer all of your questions. Okay, but for time being, well done, guys. So you're already in profit, and let's see how much profit we can make from this trade.
Plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Turkish central bank cuts its key rate and says it's ending its easing cycle. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So first thing is first, let's always check on the markets, especially on a day like today, like we're seeing a little bit of pressure across the board. It's really some of the technology stocks that are leading the way down, but also some of the banks. Now, stocks overall are falling because of some of the policy that we heard yesterday. I guess today at the forefront, concerns about tightening monetary policy and economic risks from the fast-spreading Omicron virus variant is sapping a bit of sentiment. But we didn't have it yesterday, and nothing really has changed that much since yesterday, so it could also be a bit of profit taking. If you look at central banks globally, they do seem to be prioritizing this fight against the elevated inflation by tightening monetary policy whilst keeping an eye on the impact of Omicron. The other story we're watching very closely, another record low, and it's really quite incredible how fast it's touching that new low against the dollar, is the Turkish lira, marking an all-time new low at 16.1 per dollar. The other thing we're looking at is natural gas. Now, this goes to some of the politics that we've been following very closely. We, of course, look at natural gas, and that's a great chart, which we'll get onto Tina Fordman in just a second. Russian troops are still gathered near the Ukrainian border. The Biden administration is pushing its European Union allies to finalize a broad package of sanctions against Russian banks and energy companies should the Kremlin invade. With 40% of Europe's gas imported from Russia, the potential disruption of global energy markets could prove problematic.
It's of great importance to all of us here that Europe's borders are not moved, that everyone exists in security.
We maintain our call on Russia to de-escalate tensions and refrain from any further aggression. We would like to be in a situation where relations with Russia are good, but this is very much depending on the choices made by Moscow.
We had an important discussion with President Zelensky, and we have very clearly reaffirmed our attachment to the Normandy format, also together with Russia.
We have agreed that if there is a military aggression against Ukraine, consequences would be massive. We are disposed to coordinate concrete and operational measures together with all of our allies.
Now, from all of this, let's get straight to our European correspondent, Maria Tadeo, live for us in Brussels. So, Maria, Europe warning of massive consequences. What could those actually be?
Yes, Francine, massive consequences if Ukraine were to be invaded by Russia. That was the language that came out from this European summit that happened yesterday. We know that for 2 hours, European leaders were talking about the situation in Ukraine. Mr. Zelensky, of course, the Ukrainian prime minister, was also in Brussels 2 days ago debating the situation. Now, European leaders, as I said, agreed that there will be, quote, massive consequences for Russia, that the economic damage on the country would also be very significant. But of course, we still don't know what that means in practice. Yesterday, the head of the European Commission said there is a list that could be put ready to work, but we still need to know what companies, what assets, and whether or not the people that would be hit would be very close to Vladimir Putin or not. That is something the United States, as you know, has been pushing very hard to have something on paper that would serve as a deterrent for Russia. The only thing I would also mention, Francine, is that yesterday we found out that the German regulator is probably not going to approve or certify the Nord Stream pipeline 2 until the second half of 2022. So that's a very clear signal that Olaf Scholz is not in a rush to approve this by any means.
Thank you so much, Maria Tadeo there, our European reporter joining us from Brussels. Now, the impact of COVID is, of course, going to be top of mind for most investors next year. According to Avonhurst Advisory Services, there's a wall of additional worries facing the world in 2022. These include tight supply chains, interest rate hikes and inflation, as well as trade and political tensions surrounding China. Other concerns include post-Brexit trade war between the UK and Europe and cybercrime. Now, joining us to discuss all of this is Tina Fordham, partner at the head of Global Political Strategy at Avonhurst Advisory Services. Tina, thank you so much for joining us. Why don't we kick it off with Russia and actually some of the sanctions that we could see from there. Let me also bring you to a beautiful Bloomberg chart that looks at European natural gas prices plunging from a record close after Russia topped up fuel to region for the last time. There it is. Look at that. You can chart anything on the Bloomberg terminal. When you look at that, Tina, what does it mean for political risk going forward?
What we've got is the most complex backdrop from an economic policy perspective than we've seen for some time, right? No investor today has dealt with rising inflation, rising interest rates, let alone the extra impact of COVID. And on top of that, if any of the geopolitical risks in our wall of worry were to manifest, we're talking about a much more volatile environment. Russia-Ukraine is just one, but I would say we should be thinking about whether Russia will invade Ukraine again.
What does that mean for actually how allies could respond? So if I don't know whether at this point, so what, December 17th, 2021, we need to model and game theory if, some of these political risks that you outline in your 2022 wall of worries come up all at once. What does it mean for the world?
Well, it means, first of all, that policymakers' reaction function is much slower, right? I mean, I sometimes say kind of, flippantly, policymakers can do one thing at a time, and that thing is COVID. Central bank officials obviously dealing with rates, and these are what the factors markets are looking at most closely. What I think investors fail to appreciate about geopolitical risk is that this environment is actually a very opportune one for those actors willing to take advantage because of that slower reaction function. Biden has already said the U.S. won't militarily defend Ukraine.
Tina, this is what we have on your wall of worry. If we keep that up actually for a second, because it lays it out beautifully. You have inflation, which we talk on the show every day. Cybercrime, are we underestimating? We also talk about the China sanctions every day, but do we underestimate what impact cybercrime could have on the economy?
Well, cybercrime, among other effects, is a very useful way to continuously chip away at the defenses of great powers. But what's important about it, I suppose, is it's below the threshold of a military response, right? Any bank is being attacked every day. The governments of the United States and all European countries are being attacked every day, all the time. And this is part of a continuous sort of assault and a way of keeping big powers on the back foot and not prepared for other things. What worries me the most is that Iran, from the wall of worry, is getting close to nuclear capacity. Yeah. And both China and Russia have looked at how the West has handled COVID and said, these people are not going to be in business for long. And I think
which means what? That China could actually, for example, invade Taiwan and think that there's no consequences of this?
I think China is much more risk averse than Russia is. Maria talked about the deterrence factor of the current sanctions at play. China does not want to prompt anything requiring a military response, but China's also been very adept at changing the facts on the ground. And one of the things I always advise clients about is not to think in binary terms, invasion, peace. What about soft annexation, right? What about creating more disturbances? We've already seen more of that. And this kind of incremental posture can be disruptive.
But unless there's something ugly, the markets seem to ignore it.
That's right, because the markets too can only think about one or two things at a time, and that's interest rates and inflation and a bit of COVID. Even that's not registering, and that means that any geopolitical risk will be considered a surprise, even though it's definitely not.
One of the other things, I mean, if you look at, for example, China policy when it comes to the economy, are we underestimating or even misunderstanding the huge shifts that China would go through in the next couple of years?
Well, China is playing a long game and consolidating power as we go along. China is not likely to be more aggressive, but one of the things I'm tracking is how China and Russia might not perhaps coordinate as in lockstep, but hide behind each other in a way that we've seen, for example, at the United Nations, in order to accomplish what they really want, which is to change the rules of the game in global institutions to suit them.
Which is what? I mean, what could actually come, right?
Yes, to change trade, to change the way the UN works and everything else so that they can, manipulate those institutions more to their advantage and impose more costs.
Tina, if you look at trade, I mean, supply chains have already moved quite significantly. So would this be China trying to, through political influence, trying to get them back?
Trying to get it back? Well, no, I think it's more to do with what China is doing in other places to control lithium supplies, making inroads in Africa and the Middle East with grain and soft commodities, and doing this all below the radar.
I mean, we also have a French election next year.
Yes.
How disruptive could that be?
Well, it's something that we all know how to watch. I think this is the 5th French election that I will have been tracking. We always see these headlines about the kind of, potentially most disruptive candidate, and that time it's Eric Zemmour. This time, rather, it is. It's very interesting to see the new candidate on the right. I think the base case has to be that Macron gets a second term, but what really matters about the French election is what it means for European cohesion and this so-called Franco-German axis in a world without Merkel. Although I would say, as an Italian, you will appreciate, let's keep an eye on what Mario Draghi does in terms of whether he goes for the presidency or stays on as prime minister, because I think Draghi is the European leader to watch in particular.
Yeah, we don't know how long he stays, of course, as in charge of the government. Thank you so much, Tina Fordman there, a partner and head of global political strategy at Avonhurst Advisory Services. Now, coming up, Barclays, Goldman Sachs, JP Morgan all plan to boost bonuses as banks seek to gain an edge in the deal boom. More on that next. This is Bloomberg.
India might be securing jobs for its highly skilled elite, complicated, uncertain taxes have pushed most foreign companies in need of cheap labor towards China. That's costing the economy an estimated $140 billion a year.
They've been saying they're open to the rest of the world, but there are still a lot of protectionist barriers on doing business with India.
To follow in China's footsteps and reach the government's goal of being a $5 trillion economy by 2025, India needs to create a model which succeeds both at home and abroad.
crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, some of the biggest banks on both sides of the Atlantic are planning big payouts for their staff. Record results and intense competition for staff are driving the trend. Barclays, Deutsche Bank, Goldman Sachs, and JP Morgan are all set to be considering boosting bonuses by up to 50%. As Omicron rages through many countries, many large...
Okay, guys, as you can see, 113.30.5. We made £200. Well done. Well done. Let's move on. Let's see what other pairs what chance we'll get, what kind of opportunity will bring us other pairs. Okay? Stay safe, guys.
Have the best staff.
Yeah, there's definitely that sense out there. So earlier this week, you had Goldman and JP Morgan saying for its deal makers, you're looking at 40 to 50%. And then yesterday, Barclays were reporting that they're going to boost their whole bonus pool for the whole investment bank by more than a quarter, and that is pretty extraordinary. So clearly Barclays are looking to compete with the Wall Street's titans. And then a slightly different story at Deutsche Bank, where there's sort of a larger range, 10 to 20%, again, just for its deal makers. So that's a slightly different story there.
I mean, is this one of the first times where we're seeing actually European, UK bank trying to compete in terms of bonuses, where they're just the revenues are not as strong as JP Morgan or Goldman Sachs?
Yeah, exactly. And I think it shows to Barclays' ambitions in this space. They are clearly not moving away from this kind of transatlantic model, and they want to be sort of seen as on the same level as a Goldman or a JP Morgan. But yeah, it's pretty surprising to see a European lender, which typically is a bit more conservative.
Talk to me. I mean, first of all, does it get scrutinized by regulators? And it doesn't. It's not the same bonus as you're saying if you're a trader. Of course, if you're a junior or if you're an M&A this year.
Yeah, on the regulatory side, so last year, the regulators were kind of putting quite a lot of pressure on saying, be careful with what you pay. So that's partly why you're seeing these big jumps this year, because they've kind of stepped back from that. Now the banks are seen to be sort of capitally strong enough to pay what they wish. And then you have to remind me what your second question was.
The second question was simply if, the revenues are a little bit different from one bank to the other. So does it actually, I mean, can they afford to pay this much?
Yeah, and I guess it's a real, that's the delicate balance in that, right? Like, it's kind of, can you keep your talent? Can you, no one's ever going to be happy whatever the bonus is, but can you keep them largely on board? Because, in this world, it's really that talent that drives that revenue. So it's, as long as you want to be a big player in this space, you kind of do have to pay up at the moment.
I mean, we're on to the second year of the pandemic. I mean, there's this funny meme saying, 2022 is a bit like 2022, which is getting people a little bit depressed. We talk about this great resignation. Have you seen a lot of bankers move around? And does that, A, filter into the flexibility, so the work from home that bankers are giving their own staff? And two, is that why bonuses are up?
Yeah, we're definitely seeing people leave the industry. I mean, I think it's ever thus. Finance is notoriously hard charge, and you have to always work these hard hours. I think it's sped up both for the pandemic, but also these rival industries like tech, even fintech. That's sort of where some bankers are now starting to think, I can make as much money there, and it's a better quality of life.
So you had a lot of titans in finance saying, guys, you have to go back to the office. It's our culture. It's our DNA. Is there anyone that's left saying, no, you can't work from home?
I think right as of this moment, no one is going out there publicly saying, hey, we want everyone in the office, obviously. I mean, James Gorman at Morgan Stanley actually said, you know what, I was wrong to say we should all hurry back to the office. But I think realistically, I think everyone's saying, let's see what Omicron brings. But if it goes back to what it was like a few months ago, I think you'll once again see a big push for folk to come back into the office.
Tom, thank you so much. Our Tom Metcalf there, Bloomberg's European Banks editor. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gearens. Hi, Leanne.
Hi, Francine. The Bank of Japan has kept its key rate and policy settings unchanged, citing a high degree of uncertainty from the pandemic. Officials opted to extend a COVID funding program for small and medium businesses until September. The BOJ says it will gradually reduce its holdings of corporate debt to pre-pandemic levels starting in April. inflation. Bloomberg has learned that the Bank of Montreal has expressed interest in buying the US business of BNP Paribas. Sources say BMO has held initial talks for the Bank of the West unit, which had a book value of about $14 billion as of the end of September. A wave of foreign lenders have been leaving US retail banking. And Airbus has handed Boeing another defeat, this time in a deal with Air France-KLM. The Franco-Dutch carrier has agreed to buy 100 A220 and A321neo aircraft from the plane maker. The order is worth more than $10 billion before typical industry discounts. This is just after Australia's Qantas also picked Airbus over Boeing for its fleet upgrade. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Coming up, humiliating defeat. The Tories lose a previously safe seat in a by-election. We look into what that means for the Prime Minister, Boris Johnson. That's coming up next. And this is Bloomberg.
An extra $1 trillion in spending, not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we, frankly, have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the President's agenda, what I like to call the big deal, but Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of health care, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Actually, the labour market is very tight at the moment, and companies around the country, when I talk to them, tell me this. This is the number one story. Talk about difficulties of recruitment. Secondly, there are, I have to say, signs of the inflationary pressures, which of course are difficult. You know, inflation at just over 5% is difficult. What we've been looking very closely at is how persistent it's likely to be, and there are signs now of
Back
more persistent price pressures, and that is a concern to us.
Bank of England Governor Andrew Bailey there speaking after this week's interest rate rise. Now, staying with the UK, and the Prime Minister, Boris Johnson, has been dealt a serious blow with the loss of a safe Conservative seat in a by-election in the West Midlands. Now, the Tories lost a seat they've held since 1832, with the Liberal Democrats winning by almost 6,000 votes. For more, we're joined by Bloomberg's managing editor for European politics. She is Flavia Kraus-Jackson. Flavia, good morning. Thank you so much for joining us. This feels very significant. How bad could it get for Boris Johnson?
Yeah, I mean, I think as we like to say it here in England, it was a proper kicking, and I think that's the way to interpret this. The Tory party was sending, and the electorate, of course, was sending in the same week very, very strong signals that Johnson is just not doing a good job. First, there was the revolt of 100 MPs, which essentially annihilates his 80-seat majority, and now with the electorate. So it's definitely a cause for concern. Now, as to the question of whether this is the beginning of the end, it's a question that everyone is asking. I think one has to sort of remind everyone that the Tory party can be ruthless, and when they feel that their guy is no longer a winner, then they can get rid of him. So the critical element to this is, how many letters are going to start coming in, and that would be the first sign that he's in trouble. Our sense is that we're not quite there yet, that Christmas will provide a little bit of respite for him to sort, in a way, kind of like pick himself off the ground and try and turn it around. Of course, if Omicron suddenly just keeps spreading at the rate it has, it's just going to look even worse for him. So there you have it.
Is there anything that he can actually do to turn around? How did we get here?
I mean, it's someone reminded me that this is like the season finale of Succession or something. Like it all, Owen Patterson, this was an incredibly safe seat. And it all started with Owen Patterson and how Johnson tried to protect him, right? So it was an incredibly self-inflicted wound. Then the Christmas parties, etc. So it's gone completely full circle. I think the key thing is that as we saw with Theresa May, who was desperately weak, it took quite a while for the party to finally get rid of her. So I think the scenario that we're looking at is potentially 2022 late, to see if Liz Truss and someone like Rishi Sunak can somehow get a bit of momentum and maybe mount a leadership challenge. But, in the meantime, he's going to have to do that thing that he does, make people laugh, make people feel good about themselves, stop inflicting self-inflicted wounds on the party and on the country.
All right, Flavia, thank you so much, as always. Flavia Kraus-Jackson there with the very latest on UK politics. Now, let's also check on the markets. A lot of the pressure coming in from some of the technology sector. This is after we had a major week for central banks across the world. We're also looking at the Turkish Central Bank, and we're looking at the Turkish lira, 16.52. That's the kind of weakness that we're seeing across the board. Not something that we would have imagined a couple of months ago, but certainly once it got through that psychological level of 14, then it's been in free fall ever since. Stocks extending declines amid a drop in global technology shares. Again, the concerns in the markets is tightening monetary policy, but also they worry about this economic risk from the fast-spreading Omicron virus variant, which is sapping sentiment. If you look at the backdrop, investors now questioning whether global stocks are due for a rougher patch after almost doubling from the pandemic lows. We'll have a look at that. We'll also look at what it means for some of the emerging markets. It's not only about Turkish lira, but we're seeing a movement also in the South African rand. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller in Berlin, Katie Lyons in New York, and Anna Edwards in London. This is Bloomberg.
So what happens is that we create some icons, we call them tags, and they have a signal within them. And when you stare at that, your eye responds to it in a particular way. So the way in which that eye response occurs is a signal that we pick up on the visual cortex of the brain at the back of the brain. So the sensor is looking for the signals we create here that come through the eyeball, through the brain, and then onto the visual cortex. Once we've got it there as a signal, we can grab that, we understand what that signal looks like, and we can turn that into a command for whatever we're trying to control. There's multiple places where we think this technology can be applied, perhaps in, I don't know, driving or commanding unmanned ground vehicles or unmanned naval vessels, perhaps providing menu selection and control within a control room environment, maybe in a nuclear power station. All those kind of things are perhaps in the bailiwick of this technology.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Inflation is running well above target, and growth is well above potential.
And there are signs now of more persistent price pressures.
It is very unlikely that we will raise interest rates in the year 2022.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It is 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Friday, December the 17th. Our top stories today. Ratcheting up the pressure on Russia, the U.S. is pushing the EU to prepare sanctions in case Vladimir Putin invades Ukraine. Turning up the heat on China, the Biden administration imposes sanctions on Beijing over its treatment of ethnic and religious minorities. Congress targets companies that use Chinese forced labor. And President Biden paints a bleak outlook for the unvaccinated. He warns they risk a winter of severe illness and death. Welcome to Bloomberg Surveillance Early Edition, everybody. From London, I'm Anna Edwards with Tom McKenzie and Caroline Hyde, in for Kaylee Lines and Matt Miller. Good morning, everybody. Tom, it seems that European equity markets reflecting the global nervousness we've seen recently, the twin threats of Omicron spreading and central bank policy becoming tighter.
And that divergent picture between the central banks, notably, of course, the ECB and the BOJ, arguably on one side, the Fed and the BOE on the other. We had red across the screen on the Asian session. Japan really weighing up the impacts as well of Omicron. They're trying to ramp up the booster shots there. And the BOJ essentially holding off on significant tightening as they try and wrestle with, yes, an inflationary picture that is very different to what the Japanese have expected and seen over the last few years, but also that threat of Omicron as well. The Nikkei is lower, closed lower. You saw some pressure, of course, on mainland stocks in China as well. Tech companies as well. Chinese tech companies continue to be hit and scrutinized. And then you have the property sector, a downgrade for Shumao, one of the big developers there, by Fitch, following on from Moody's. That is a story and a theme that continues. Let's switch focus and see how things played out on the US. It was technology as well, and the NASDAQ closing lower by more than 2%. Apple was a big loser yesterday, closing lower by more, so almost 4%. Semiconductors also under pressure. In terms of your US 10-year yield, the yield's edging up about 2 basis points. It's at 142, and the futures stateside pointing to further losses of a little over 0.1%. Caroline.
Yeah, let's get the mood music, what's happening in terms of Europe at the moment, Tom, because as you said, there was this, of course, risk aversion that sunk into the US equity market in terms of the NASDAQ technology. We follow it lower as we once again focus more on perhaps what will happen with central bank policy actually stifling off growth, and indeed what happens in terms of the Omicron virus. I look at a sea of red across Europe. The French indices off by some 0.6%. You're looking at the DAX in Germany off by 0.5%. UK, one little ray of green at the moment, just up 0.25%. But let's switch it on a gear. I want to look at some individual bits of data that we digested here in Europe, which some of it was relatively optimistic. Let's go half glass full to begin with, because I want to look at what happened in terms of UK retail sales. Let's have a look at industry groups, because at the moment we're seeing retail sector doing particularly well. Retailers on the higher side, as we saw that UK number come in stronger than anticipated. This for the month of November, but what then of December as we see those restrictions ramp up once again in the UK. On the second flip side, though, is the auto sector in the worst performers here in Europe. Auto sector, therefore, is why Germany's on the downside. Why is that? Because for November, we had a record low registration rate for new car sales here across the continent of Europe. The supply chain is front and center. We're seeing a move into some of your havens today, Swiss franc being namely one of them if you're looking at FX picture here in Europe, Anna.
Yeah, Caroline, with the pressure on technology names and that bad news out of the auto sector, difficult for the German market certainly to make any headway, and it doesn't. Let's have a look at what is happening today, what is on our radar for today. There's two events to watch out for in the United States. A quarterly rebalance of the S&P 500 after market close, and triple witching as stock derivatives expire, potentially causing volatility, and index derivatives, of course. Ryanair bids farewell to the London Stock Exchange. That also is set to happen today. It's the company's last day of trading in the UK capital after blaming its departure on Brexit. It, of course, will be listed in Dublin. It is not Ryanair style to go quietly, so we'll see. And it is the Bank of Russia's rate decision at 5:30 a.m. New York time. Inflation continues to accelerate, adding to pressure for the central bank to keep tightening. 100 basis points last time around. Expectations for a similar sized hike this time around. Now, European leaders have warned of massive consequences for Russia if it were to invade Ukraine. EU leaders spoke about rising tensions with Russia in press conferences following a summit in Brussels.
It's of great importance to all of us here that Europe's borders are not moved, that everyone exists in security.
We maintain our call on Russia to de-escalate tensions and refrain from any further aggression. We would like to be in a situation where relations with Russia are good, but this is very much depending on the choices made by Moscow.
We had an important discussion with President Zelensky, and we have very clearly reaffirmed our attachment to the Normandy format, also together with Russia.
We have agreed that if there is a military aggression against Ukraine, consequences would be massive. We are disposed to coordinate concrete and operational measures together with all of our allies.
Let's get more with Bloomberg's Maria Tadeo, who's standing by for us in Brussels. Maria, good morning. So Europe now warning of massive consequences, some tough language, but what will that entail in detail?
Yes, Anna, and we heard it right there, that language yesterday. There will be massive consequences if Russia were to invade Ukraine, and the economic repercussions of this would be immediate. Now, we know that for a while the United States have been pushing on European allies to come up with a concrete list of companies, sectors, and people that would be targeted if there was some type of military intervention in Ukraine. The European Commission yesterday did not give specific information, but they did say we have a list that would be ready to go. We also know that for more than 2 hours, European leaders spoke behind closed doors here in Brussels. There were no phones allowed in that room. That happened when it's a very delicate, very sensitive situation, but also they don't want any hacking or any leaks. So it does show that this is very much top of the agenda. I would say, yes, we didn't get a lot of specifics, but that language that we played there, immediate repercussions, massive repercussions, that is a huge change in tone from the European Union, which you remember just a few months ago still said that there was space for dialogue directly with Vladimir Putin.
Maria, we've seen a drop in gas prices today, Russia increasing the supply to the European market. This is a topic that was discussed as well by European leaders. Do they come to any conclusions, any agreement on this issue?
Well, look, it's a number of things. On the one hand, we know that Vladimir Putin has kept the supply very tight this winter, but we also know that he's always very careful not to be in breach of contract through Gazprom. That's something that the European Union has always been very clear that Russia needs to honor the contracts. And secondly, of course, we know there was a big debate yesterday that energy prices, this is top of the agenda for many European governments. We're seeing prices pretty much skyrocket every day, and this is going to be a very expensive winter for many citizens across the European Union, but there was no agreement, and one of the sticking points, and this is really the issue now, is what to do with nuclear energy. The European Union was looking to transition away from that, but they're now seeing that this green transition, moving away from brown to green, is very expensive. You need a method that can transit from one to the other, and the question is whether or not nuclear energy will do the trick. There is no consensus around that.
Meanwhile, of course, we see gas prices in Europe slump today on the fact that Russia decided to turn on the taps to a certain extent. Maria, today, always great to have your updates. We thank you on the political side of Europe. Let's turn to the political side of the US. Over in Washington, well, Bloomberg's learned that the US is pushing the EU to finalize a package of sanctions against Russian banks and indeed their energy companies. That would be imposed if the Kremlin does indeed attack Ukraine. Emily Wilkins, Bloomberg government reporter, joins us from DC. Emily, the latest here, because once again, foreign policy front and center.
So at this point, we are hearing that the U.S. is trying to pressure their allies in the EU to really finalize this package of sanctions and have it ready to go. That way, the threat looks more credible when they come to Russia and say, hey, this is the price you're going to pay should you invade Ukraine. Now, not everyone is on board with that. There are still individuals in the EU who think that there needs to be time and space for diplomatic efforts to be reached. But President Biden, I mean, he understands sort of the threat that's being posed by Putin. He wants to make sure that he's responding in an aggressive way. You saw him really talk about this issue a lot last week, have that virtual summit with Putin. You know, this is going to be a bit of a test for President Biden. When he came into office, he said that part of regaining the U.S.'s foothold as a leader in the world would be working with their allies, and certainly the ability to work with the European Union on issues related to Russia. This is going to be a test of how well he's able to do that.
Emily, let's pivot from Russia to China, and I see that the Senate cleared a bill that it seeks to punish China for alleged oppression of the Uyghur Muslims. What is the detail here? What do we look ahead to?
So the legislation, it's cleared the House, it's cleared the Senate. All it needs right now is President Biden's signature. It would basically put an import ban on products from the Xinjiang province over concerns that they are being made with forced labor. Now, if companies in the area could prove that they were not making products with forced labor, they could potentially get a waiver to import their products to the U.S. But this is meant to send a very strong message to China that the U.S. is very concerned about allegations of human rights abuses, particularly with the Uyghur population. In addition to that, you saw various agencies take steps yesterday to add Chinese companies to various lists, either banning American companies from working with them or banning U.S. investors from investing in them. And this is really continuing a pattern we've seen throughout the Biden administration and a pattern that we saw in the Trump administration as well.
Yeah, United Nations saying that up to 1 million people have been held in those camps in Xinjiang, in China. China, of course, saying that these are just educational programs. Emily Wilkins of Bloomberg Government in Washington, thank you for the update there. President Biden is warning unvaccinated Americans that they face what he calls a winter of severe illness and death. The president urged initial doses and booster shots in the midst of a surge of coronavirus cases.
It's here now, and it's spreading, and it's going to increase. For unvaccinated, we are looking at a winter of severe illness and death for unvaccinated.
Sam Fazeli, Bloomberg Intelligence Senior Pharmaceutical Analyst, joins us now for more. Someone really who's been doing the deep dive on this subject from day one. Sam, always great to get your insights. Where do we stand then in terms of Omicron, the effectiveness of boosters, and just how severe this variant is in terms of hospitalization rates in the US and elsewhere?
Yeah, hi. Obviously, in the US, we really have no idea yet. I think the best data is coming out of South Africa, which, as I've said before, we have to take with a pinch of salt in terms of trying to extrapolate to other countries because of the demographics of the country, et cetera, and number of infections. But the data, excuse me, coming out of South Africa seems quite positive. We've just heard that number of hospitalizations are down by 91% in this current wave compared to the previous wave, which is great news if is going to be the same as what's found in other regions. And I do worry about the United States.
Right, so this is, good morning, Sam. This is good news from South Africa this morning. Certainly nice to have some good news on Omicron. But you've been very careful to point out to us a number of times before about how we can't just translate the South African experience into other geographies. Remind us of the backstory there.
Yeah, so in South Africa, depending on which province you look at, 70 to 80% of people have been previously infected. When I look at the numbers that we have here for other countries, you know, United States sitting at 15%, Germany at 8%. How much immunity does prior infection give you? We don't know, but it will give you some. And then you've got vaccination rates, which of course South Africa's unfortunately not as far ahead as some of the other countries. But again, you look at the United States, they're at 61% compared to say 79% in France and 88% in Portugal for 2 doses. So all of that combined together suggests that if immunity, which is I believe the case, a significant driver of the severity of the disease that you get with these upcoming, this variant and other variants, then we have a problem in the rest of Europe. And that's why we can't translate the data from South Africa directly to other countries.
Okay, really interesting insights coming through from South Africa. We'll continue to monitor those. Sam Ftse, thank you very much from Bloomberg Intelligence, of course. So that is a look at where we are on the latest on the COVID battle. Let us get now to Caroline, who can give us a look ahead to the US session. Caroline?
Yeah, as we all continue to see that Omicron variant become the focus of whether you've got your party cancelled or not, we're going to focus in on some of the corporate earnings. And, well, one of the winners, of course, within all of the supply chain issues and indeed the rise up in freight costs, it's been that of FedEx. They came out with their earnings after the bell. FedEx rising almost 5% in early hours trade. They did well after hours as well after that numbers hit. They're able to pass on their cost increase by raising their prices. Revenues rise, profit does well, the market moves higher. Let's look at Oracle, because it looks as though we're getting a little bit of M&A potentially. Oracle could sink a little bit pre-market. We could see, though, Cerner rise, as we are being reported by Dow Jones that we could see this company make a bid up to the tune of some 30 billion valuation is thought for Cerner. Now, this, of course, is a medical records company. Oracle down by almost 3% in the pre-market. And I do this one for our Matt Miller, who we miss. You've got to keep it on the EVs. You've got to keep it on the autos. You've got to keep it on Rivian, who also came out with their first ever public earnings last night after the bell. And it didn't live up to expectations. Down almost 10% in early market. This is Rivian saying, look, we're not going to meet our overall production targets to the tune of a few hundred vehicles, Anna.
Yeah, the biggest listing of the year last month. We remember it well. We'll watch that one at the open then, Caroline. Coming up on this program, the fight against inflation. We'll discuss the latest in central bank policy. Freya Beamish joins us from TS Lombard. And tech stocks signaling more pain ahead after yesterday's decline. Nasdaq futures down 0.6%. More on the tech sector shortly. This is Bloomberg.
What do we know and what don't we know? Because there's a lot of speculation, a lot of anecdotes circulating right now.
Omicron definitely has the characteristics to create us concern for many reasons. But also we have been preparing for a moment like that for months right now. And I feel comfortable that the playbook will work. So what is the playbook? One, it is to understand more about this virus. The second, of course, will be protect against infections. And the third is to treat. Let's take it one after the other to understand. I think there are a few things that are not very clear yet with Omicron. One, it is the clinical manifestation of this new variant. Is it creating more severe disease or not? Is it transmitted easier or not? Is it going to younger or older people? All of these are things that as we see clinical cases coming out and the numbers are getting bigger, that's something that we will know in a few weeks.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Now, this week has been dominated by two key themes, Omicron and central bank policy, and the divergence in central bank policy. Great chart coming from the terminal today, and we give a shout out to Valerie on the back of this one, because we see really the Bank of England, of course, going in alone, hiking rates, taking the market by surprise, of course, yesterday. And therefore, in 2022, we're expecting, 3 rate hikes coming out overall? But Federal Reserve signaling its path to us of more hawkish tilt, but a sort of dovish hawkish tilt. We're expecting some 3 rate hikes into 2022. Therefore, mid-2022, the chart is showing about 1.5. But then, of course, the ECB, Madame Lagarde, saying, no, no, no. We're still seeing this inflation as transitory. No hikes in 2022. Interestingly, the market does not know what to make of this. In the US, the Treasury market, well, we saw the yields on the 2s and the 5s come down significantly yesterday. They don't buy maybe those Fed hikes to the same extent the 8 signaled by the Federal Reserve. What then of corporate credit amid all of this? If yields in sovereign debt are going to remain so low, is it time to get into corporate credit? Dana can be talking it through with us. Dana El-Baltaji, she's a Bloomberg managing editor for EMEA Credit. And you've been looking at the high yield response in particular and some of the key parts of the market. What did it make of, for example, the Federal Reserve's dovish hawkishness?
Well, this was really interesting, actually, especially for junk debt out there, because on the one hand, we had this beautiful anchor for the last almost 2 years, really, where junk debt has managed to really thrive. And yet now we're seeing that slightly lifted, and we are seeing the threat of it lifting even more. But they were comforted by the fact that the central bankers, not just in the Fed, but here too, are very concerned about growth, and they don't want to hurt economic growth. And where there is economic growth, that's great for junk's debt.
Dana, let's pivot to what's going on in certain emerging markets, and I'm interested in what's going on with the Turkish lira, a clearly very volatile currency these days. I mean, moving another 7%, weakening another 7% today. The focus has always been on the slightly unconventional central bank policy here. We saw more of that yesterday, but we were told that actually the rate cutting cycle is likely over. That's what the central bank said, but it doesn't seem to have put a floor under the currency.
No, absolutely not, because after the decision, the government basically went and raised the minimum wage by about 50%, which will be implemented next year. Now, the thing is with that is that will add more inflation in Turkey, which is the last thing that the nation needs. So when you have a currency that's tanking and you've got inflation that's going through the roof, what you don't need is to take away one of the things that would make the nation actually attractive to foreigners, which is the relatively low cost of labor. So, I mean, it's very hard to know where the currency is headed, but what we do know is that certainly that those corporates that do have foreign debts may find some issue with refinancing next year.
Dana, I want to fold 2 into 1 here. The idiosyncrasies of the monetary policy response in Turkey, can that keep it contained to Turkey, or is there a bleed across to EM? And what does 3 hikes from the Fed, the dot plots, of course, that's the forecast, what would that mean for EMFX leading into 2022?
All right, so first with Turkey, I think because the circumstances there are so specific to Turkey, I think right now a lot of people kind of accept the fact that it will be contained within Turkey. With regards to the impact of these rate increases in EM, I mean, what we're seeing is, for instance, Russia and other emerging markets are raising rates, and they're trying to be ahead of the curve so that then they maintain the integrity of their own currencies. They will have to be dealing with a stronger dollar, and that's why they are trying to be more proactive.
Okay, another 7% move on the Turkish lira then against the dollar today. Dana, thank you very much. Dana El-Baltaji joining us there from the Markets Live team. And remember, you can get market analysis. Check out MLIV Go on your terminal. This is Bloomberg.
front, when your shares are down 20%, it's got to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
You have to really keep in mind vaccination is the first line of defense. And at the end of the day, whichever vaccine you take is going to be better than no vaccination.
How will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap in between people that were worried about climate and people that were taking action.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Caroline Hyde with Anna Edwards and Tom McKenzie in London. Now let's get the first word news. In the UK, it was a pretty humiliating political defeat for Prime Minister Boris Johnson. His ruling Conservative Party lost a key parliamentary election to the Liberal Democrats. It was a seat the party had held since it was created in 1832. Goldman Sachs says it can't rule out oil at $100 a barrel. That's in 2023. That's because supply additions are expected to be too slow to keep up with demand. Goldman's base forecast is still for Brent to stay around $85 the next 2 years. The bank says that consumption of gasoline, diesel, and plastics is expected to reach new highs. And in fact, Corvalin, who is writing this particular prediction, thinks that oil prices could go as high as 110 unless we get some demand destruction.
And so you have to look through, obviously, the immediate impacts of the reductions in travel and people cancelling trips, because, of course, that's going to be a drag on oil. In the near term, you're seeing losses of, what, close to 2% across Brent and WTI, but longer term, that projection.
Yeah, absolutely. They focus on insufficient supply in the face of that strong demand. There's a lot of uncertainties around both of those, the supply and the demand side. We'll watch the oil story for you. Coming up, Freya Beamish, T.S. Lombard, head of macro research, joins us. This is Bloomberg.
antibody responses produced by this vaccination is able to potently neutralize the virus and a number of variants of concern. A lot of the vaccines being developed currently require super cold storage. One of the great advantages of our patch is that we're able to remove the cold chain. We've been able to stabilize the vaccine on the patch for at least a month at room temperature and a week at 40 degrees. So this makes logistically vaccine rollout a much simpler proposition, removing the cold chain from transport.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. From London, I'm Anna Edwards with Caroline Hyde and Tom McKenzie in for Kaylee Lines and Matt Miller this morning. European equity markets, Tom, very much on the back foot. The twin concerns then around the Omicron variant and, of course, policy tightening globally, not just the sort of hawkish pivot from Jerome Powell and the Fed, but elsewhere. We've seen this picking up momentum.
We have indeed. Certainly the emerging markets are making sure, as we were discussing earlier, that they don't want to be caught out by the three hikes that are now penciled in by the Fed and the pressure that could put on their capital accounts and outflows. So they've been hiking rates. And in terms of the divergence as well, that's split arguably between the ECB, BOG versus the BOE, which of course hiked yesterday, and the Fed that's laid out its time frame in terms of the taper and those dot plots.
Yeah, inflation a concern in Russia as well, waiting for a Russian rate decision. There we go. The rate hike possible at one of the next meetings, so says the Bank of Russia. So we will follow these headlines as they come through. The expectation had been that we would get a 100 basis points rate hike this morning. So we'll continue to focus on that. There we go. There's the red headlines. They're raising their key rate to 8.5%. That was the estimate. So this is in line with expectations, raising their key rate in Russia. It's a growing theme, Caroline, rate hikes.
It is hawkish sentiment, unless you're the ECB, of course, which says, look, not getting any rate hikes until 2022, although we did know that Madame Lagarde is just trying to pull away a little bit at that stimulus. I'm looking therefore in the reaction to the ECB yesterday, and mainly in the reaction to what happened in the United States yesterday. The Stock 600 is currently off by 0.75%. We've got a bit more of risk aversion in the market today. The S&P 500 futures also down by 0.3%, but the NASDAQ is also where you want to be looking. Many questioning how much these growth stocks can weather the increase in interest rates. Of course, we saw a significant fall in the NASDAQ, down by almost 2% yesterday. Money moves out of the US 10-year. We've got a little bit more flattening in that yield curve, though. The bond market is signaling they do not anticipate the growth that the Federal Reserve does. And can we really see those 8 rate hikes if they go this fast to begin with? Bitcoin, I do this for Matt Miller, off by 2.5%. I'm afraid it's a risk asset for now. It is not an inflation hedge. 46,879 is where we trade. Flip it on a gear and let's look at the individual pre-market movers. FedEx up almost 5%. Their earnings coming in strong, helped by the fact that they raised their prices. Freight costs went up. They passed that on. Sales do well, up more than double digits. Cerner gets a bid, we understand, potentially from Oracle. There are the reports up or more than 15%. Rivian down as their earnings miss expectations in terms of production. And Tesla, well, Elon Musk, he keeps on selling out of those shares.
Tom, what are you watching this morning?
Well, of course, you know, technology and the sell-off on the NASDAQ yesterday was pretty pronounced, wasn't it? And you saw the read across to the European session as well. We've got a chart, though, that shows what's happening in terms of that open interest, the aggregate open interest for technology, the NASDAQ 100 versus the S&P, and it is still there. You can see this almost crocodile mouth-shaped chart here towards the right-hand side, that demand, that interest in technology, despite the fact that we have dot plots signaling 3 rate hikes. The question has always been, to what extent can technology weather higher rates, but if you have a terminal rate of 2.5%, and that's what's being flagged at the moment, maybe the technology sector can weather that. Maybe it's also a question of distinguishing between some of the frothier parts of the sector and those big name tech companies that have the balance sheets to weather what is ahead of us. Let's get more analysis now on the call from Freya Beamish, TS Lombard Head of Macro Research. Freya, thank you for joining us this Friday. What is your take on what is happening within the technology space, within that growth space? Is it a question then of having to distinguish again between those with the balance sheets and the ability to weather inflation versus the frothier parts, the SPACs and the non-profit making parts of tech?
Yeah, I think to an extent these things are seen as trading like duration. We're not entirely convinced that that is how they should be played. But kind of in terms of how the Fed is actually going to behave and how these sectors are going to be affected, we think that there's the potential for divergence at both the beginning of the year and the end of the year in terms of where market implied probabilities of Fed hikes actually sit. And the beginning of the year is certainly dominated by this rise in inflation anxiety, this kind of global pivot among developed market central banks, obviously not the Bank of Japan, but more broadly, a rise in concerns that inflation is going to stay high. And for the Fed, that is really about the labor market. So we think that the first hike could even come forward to March, and this anxiety is just going to continue rising through most of the first half. But as I said, at both ends of the year, we're actually seeing some divergence from what's out there in terms of market implied probabilities. And in the second half of the year, what we see is this sharp bullwhip down effect in inflation of goods prices, which has been the main driver so far. And that's going to take off a lot of pressure on central banks and answer some of the questions, cutting off a lot of the threats between the potential for wage price spirals to come through, and allowing the Fed and other developed market central banks to just go a little bit more slowly.
What is the resilience of corporate balance sheets then, when you take into account all of those factors?
I mean, I think that it's the Fed is going faster because they recognize that the economy is stronger. So it's a kind of a twofold driver here. First is that they're worried about inflation being more sticky than they thought. They're worried about these spirals. We're not so worried about that. But also because they see the recovery as moving forward faster, and that's a function of strong earnings growth as well, and that should help out corporates as well.
You talk about, so good morning to you, Freya. You talk about how the second half of the year, we're going to see less pressure on central banks because, of course, of the comparatives for inflation with the year before, and that makes a lot of sense. I suppose a lot might depend, though, on what kind of supply chain disruptions we continue to see from China. And with China not having experienced very much of the COVID wave, very effectively keeping it at bay in the early days and on an ongoing basis, does that present tougher risks ahead, actually, for the global economy because of the way they will shut down ports if they need to?
Yeah, I think it's almost China's role in the global economy could help out initially, and then people could start to focus more on the growth aspects of it. So it's partly starting where you started. It's partly a function of base effects. I think markets do tend to underestimate that. You'd think it would be something that would get priced in, but in Q2 the drag from base effects will be very, very strong. But it's much more than just those base effects. So the analysis that we've done on the supply side suggests that there has been this very strong bifurcation of the capex story and the labor market story, so that parts of the supply side are now much more adapted to accommodate the positive demand shocks that you get through high periods of COVID. And that means that the inflationary shock that you receive as a result of potentially things like Omicron, new variants coming forward, is going to be much less in 2022 than it was in 2020 and 21. So you get a kind of a downtrend in inflation resulting from the previous shocks and the supply build out there, less demand coming through as well, because of a lot of the demand in the first round was simply people building for a world that simply didn't exist before COVID, and that demand is non-repeat at the same time as we have this build out in the supply side particularly for the PPE equipment, if you look at the Chinese data as well. So a downtrend in inflation, yes, shocks derived from Omicron, but I would say the inflationary side of those shocks is going to be much less than we've seen historically. And then in terms of China's role in that, sorry, go ahead.
Yeah, Fred, I'm just interested in the fact that on both the US side and indeed it seems worldwide, you're feeling the inflationary pressures aren't going to be so seismic as the market had been worrying about. Already we see in the bond market in the US, they're starting to think the Federal Reserve is not going to be hiking as much as they're currently signaling because inflation will come down. Do you rate, therefore, like mark them out for us? Is the ECB on the right track? I mean, they're still calling it transitory.
So I would move on from the transitory because it's been too long, and it's for one thing it belittles what people are actually feeling, but for another thing we can do better than transitory. Transitory is very kind of vague. So what we're doing now is to define a new framework that's specifically designed for the presence of an endemic virus. We're calling it bifurcation inflation or biflation. And there's a few results to that. One is this kind of bullwhip down effect that you see in the second half of next year. So before then, maybe the inflation anxiety continues to build, but there is a little bit of a kind of a debate going on in markets at the moment as to whether the Fed now kind of has that under control. They're ready to kind of move faster, and it's the old adage that, you know, once they start to move, do they actually need to follow through that with what they're promising? And in this case, what is driving that is the strength of the dollar. The part of the Fed forecast that has been off is the import price inflation, and if that starts to come down, then the Fed forecast look a lot more palatable. So that certainly augurs for markets moving away from this kind of hawkish tilt, but really only, I think, as we move through 2022, I think the anxiety before then can continue to build.
Okay, so bifurcation inflation is what we're heading for in the second half of the year. Freya, thank you very much. Freya Beamish, TS Lombard, Head of Macro Research. Coming up, tech unravels with the NASDAQ 100 sinking the most since September, down in yesterday's session considerably. More weakness lies ahead, according to NASDAQ futures. More ahead. This is Bloomberg.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is Bloomberg Surveillance Early Edition. I'm Caroline Hyde with Anna Edwards and Tom Mackenzie, and we're all in London. Meanwhile, let's have a look at technology companies across the pond diving in terms of, well, the speculation that rate hikes will reduce the appeal of the industry. The Nasdaq 100 is sinking the most since September. Let's try and get underneath the skin of what's going on in the markets, because it's a deeply confusing place to be right now. Christina Aquino is with us, because on one side, I'm looking at 2- and 5-year yields falling yesterday because apparently the market no longer believes the Federal Reserve can hike as much as it had signaled. But then the Nasdaq and some of these growth stocks really taking a tumble because we're worried about interest rate hikes. Is it just the immediacy of them, Christine?
Well, Caroline, I think there's a few things going on, right? Because I'm with you in the camp of confusion in the aftermath of the Fed and the reaction in tech stocks, which was positive initially. But I think what really shifted the narrative for markets is the fact that what we saw yesterday was it wasn't just the Fed that's worried about inflation. We also have the BOE worried about it, and to some extent the ECB as well. And so what you have is really a bit of a collection of the world's biggest central banks, right? Shifting towards this hawkish sort of policy and really driving home the message that the concept of transitory inflation is perhaps past us now, as Freya Beamish was saying earlier. And so I think this narrative that we've really moved on for the concept of transitory inflation, we're heading into 2022 with a concerted tilt towards hawkish policy, all that is probably weighing on tech stocks more than it initially did in the aftermath of the Fed meeting.
Yeah, Freya telling us we're moving on to a world of bifurcation inflation, something for me to dig into later. Christine, it's not just central banks in the G7 that have been talking about inflation, of course. It's also emerging markets. We've seen rate hikes there already. And Russia springs to mind today because we got a 100 basis point hike from the central bank in Russia. But that was expected because they've done it before and perhaps they'll do it again.
Absolutely, Anna. And I think the initial indication from the Bank of Russia is that we could see another possible rate hike in one of its next meetings. And so this is very much an indication, as it had been throughout this year, from the Central Bank of Russia, really wanting to signal to markets that it's doing its best to get ahead of inflationary pressures. It's no doubt that this is very much the reason why the ruble, for instance, is one of the only 3 major emerging market currencies that have held on to gains versus the US dollar this year. And investors have really responded to the series of rate hikes that we've seen from Russia. It's probably one of the most credible central banks as perceived by investors in terms of fighting inflation. It's going to be interesting, though, how that compares with the rest of the developed market complex now that we're seeing this tilt towards more hawkish policy as well, and whether those gains can be sustained in 2022.
Christine, yellow metal gold getting a bit of a bid today, above $1,800 an ounce. Does that continue that support after a pretty bad year for gold, down 4 to 5% year to date? Can it sustain some gains into 2022?
Well, no, I'm no gold expert, but I can tell you, obviously, this probably relates as well to the broader picture, particularly as it pertains to the dollar, right? And I think it really depends on, again, like how this whole growth versus inflation picture shapes out, because gold is obviously a popular inflation hedge. And so if we're in an environment where people are definitely getting a sense that inflation is really starting to become entrenched, then there's the potential for gold to capitalize on that. But then at the same time, if the dollar starts responding more to the possibility of more Fed rate hikes and faster Fed rate hikes next year, then that could be a bit of a headwind for gold. So I think what we're probably going to see is a bit more two-way risk, given that we have all these factors that are coming into fore next year.
Okay, the opportunity costs involved with gold. Christine, thank you very much. Bloomberg's Christina Aquino joining us from the Markets Live team. This is Bloomberg.
urban areas are most vulnerable to climate change. Cities consume 78% of the world's energy, while also generating 60% of greenhouse gas emissions. By the year 2100, 85% of the world's population is expected to live in cities. 90% of all urban areas are coastal. And with sea levels rising, 800 million residents are likely to be affected. 1.9 degrees to 4.4 degrees Celsius is the projected increase in urban temperatures around the world by year 2100. By 2050, 1.6 billion people are projected to be vulnerable to chronic extreme heat.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. Welcome back. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie alongside Anna Edwards and Caroline Hyde in London. The UK has the EU to thank for sending enough vaccines to fight its COVID situation. That is according to the EU's internal market chief. He sat down with Bloomberg's Maria Tadeo.
We have the quote-unquote ammunitions, including with the new booster that we will adapt now for the variant. But of course, now we need to rush.
And how many million doses do you see when? You know, I know you're working specifically with mRNA. This is Moderna, Pfizer. Yeah. You're not working with AstraZeneca. Many reasons for that. But when do you see the deliveries for those booster shots?
Well, we just ordered a new 180 million doses now. With
180 million.
180 million now with the new, let's say, vaccine to be adapted to the variant. But of course, we know that what is extremely important, because in fact, I think everyone should understand that we have two pandemics. In fact, we have still coping with the Delta variant, and which is the vast majority here in continental Europe. So we need to get vaccinated, and we have more than enough, of course. And now, of course, to be prepared for the new one, the Omicron, and we will be ready. But also, I think it's important to know that we are the first, from far, exporter of vaccine worldwide. Above China, above the US, above everyone. We will continue to export to everyone, including for our British friends, which are depending so much from us and are in a so terrible situation.
And of course, that is a message that Europe always likes to remind the UK that we are exporting vaccines there. You say they're in a terrible situation. When you look at what is happening, it's terrible, you say. When you look at what's happening in the UK, does that scare you? Does it worry you? Or actually, do you feel ultimately the same is going to happen here? Is it specific, to the UK?
Again, we have to be very cautious. What is important is that, of course, the UK is so depending from Europe for so many things, including for the vaccines. But I want to be today to say to our British friends, don't worry, we will continue to deliver what you need.
And the message that you're passing on is clear. I wonder what the reaction would be in London.
No, the message is that in Europe, we handle this together.
Bloomberg's Maria Tadeo talking to the EU's Thierry Breton with a fairly typical cross-channel, multi-layered message for the UK. Right, Tom Keene, co-anchor of Bloomberg Surveillance, joins us now. Tom, it's Friday. What is on your mind?
Friday's on my mind. This is an important Friday every year in America, but it is different this year. This is actually round about the Friday of December 15th, the real beginning of the holiday season. We saw yesterday, I believe, Goldman Sachs canceling their parties. We all know about the real challenges in America. I would suggest the greater challenges in Europe What does it mean for travel, and what does it mean for these nations? How about a chart on Italy? It's not across the channel. Maybe Thierry Breton is not looking at this, but it's the summer peaks. This is when Brad goes to Venice. My friend Brad is very good about going to Venice 2 or 3 times a year, peaking out with the cruise ships in the summer. Down we go with the pandemic, and we come back, but not so much. And Anna, you know, this is the tension that Italy and other nations face on tourism and the new bout of this horrific pandemic.
Okay, a focus there, of course, on the travel disruptions across Europe as a result of Omicron, the restrictions that some governments are putting in place. Tom Keene, of course, back with Bloomberg Surveillance just shortly. And now look at what else we're watching. We have a scoop by Bloomberg, in fact, on Huawei and reporting that suggests that, in fact, there is now evidence, and this has long been claimed by Huawei. There's no evidence. Now Bloomberg's reporting suggesting that from 2012, there was an Australian breach of a telecoms company, Huawei. Engineers were compromised by Chinese intelligence services, and they installed software. It allowed them to hack and record, and then that software self-destructed. So it just builds on the case for Huawei, which still remains, of course, a major supplier of this hardware equipment at a time and during a week when the Biden administration has hit China with additional curbs and is looking to roll out additional curbs on its tech sector.
Yeah. You're looking to Asia. I'm going to look to the US, and actually a deeply Silicon Valley story that's become a worldwide one, because, of course, we all know the story of Theranos, the blood testing company worth $9 billion, but then played into, well, accusations that she committed fraud. This, of course, being Elizabeth Holmes, the founder of Theranos. She's currently fighting in court, and the jury is going to begin deliberating later today, we understand, as the defense team closes the arguments today on Theranos founder, whether or not she did indeed build a business and not a criminal enterprise. We'll watch to see how that unfolds.
We'll certainly be watching the courtroom drama there. We'll also be watching the markets, though, I know, Caroline and Tom, because it is triple witching today, which, yeah, deserves a cheer. I never
You know what we need? Volatility. That's exactly what we need right now.
We haven't seen enough of that recently. So it is typically a very volatile period, a very volatile trading day of the year, of course. And, of course, coming just so close to the holidays, so close to the break, it can be even more volatile. The S&P 500 index has closed lower for 7 consecutive triple witching days. And reminder, just of course, if everyone needs it, that this means stock options, and index futures, they're expiring. And so that is why we focus on volatility for this particular event. A lot of people, it's suggested by some that we've been talking to here at Bloomberg, might use this liquidity to reposition if they want to around what we heard from the Fed this week, which would be an interesting development. And what was it, hawkish, dovish?
Dovish, hawkish.
Dovish, hawkish.
Which way round, Tom, should you say it?
Does it matter which?
Let's go with dovish, hawkish.
I'm not sure it matters which way you put them if you're going to use them both. But anyway, there was something in it for everybody. Maybe we take that message away. Now, more Bloomberg surveillance is ahead. We'll hear from Claudia Sam of the Jane Family Institute and David Riley of Blue Bay Asset Management. No doubt he'll have a lot to say about sterling. 2 months in a row, the Bank of England catching the markets off guard. The central bank governor of the BOE says it's not up to him to guide the markets. I wonder what David Riley thinks. More on the markets next. This is Bloomberg.
When you talk about the commercial viability, the idea that these companies can actually make money off of this here, does this become, I guess, something that's niche in the sense that you have to pay several $100,000s to do it, or does it come back down to a level where just regular folks like you and me will somehow find a way to be able to take a trip up, and this can be a business model that will be sustained?
I think it's important to note that space tourism is a small segment of the overall global space economy. Space tourism accounts for $1 billion of a global $350 billion global space economy.
What's the rest of it?
$260 billion of that is satellites, manufacturing them, launching them. And these satellites we use in our everyday lives, whether that's to listen to the radio, to watch Bloomberg on our satellite television, or to navigate us to our destination via GPS. And I hope in the near-term future, we will add getting our internet from space.
I don't think the Fed is trying to tighten financial conditions. I think the Fed is still very growth supportive.
These are still very, very accommodative financial conditions.
They're trying to reestablish their credibility as inflation fighters. The token withdrawal of stimulus isn't going to be enough.
I think there's going to be a long time that the discussion of inflation is in the air.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Friday before the holiday season. Let it begin, and it does in pandemic. Jonathan Farrow on sabbatical, lost somewhere over the Atlantic. Caroline Hyde joins us this morning from London. That is a good and beautiful thing. Lisa, this is always an important day. The setup for the holidays, the setup for into 2022. And in the calm of the markets, there's a real turmoil about where we are heading.
And are the markets really going to stay so calm? Yesterday was a remarkable sell-off in the NASDAQ as we headed into the close. How much of this is just people solidifying profits? How much of this is people realizing we have a shifted tone at the central banks? There is a hawkish tilt on a global level, and they have to respond, Tom.
And the pandemic front and center. Caroline Hyde, you are living it in London. Yes, we have it in America, but I find just extraordinary that France has decided Caroline Hyde can't have a beverage at the Vendôme at Harry's Bar here in a couple days.
A Christmas tradition for me, Tom. I'm heartbroken. Oliver Crook, our producer extraordinaire, managing to get across that border swiftly and sipping his martinis as and when he wants. But it's EU versus EU. Amid this EU summit that has been going on, all these countries acting alone. And of course, that doesn't show much unison.
Let's stop the show here. This is important for America. This is extraordinary that Italy alone, then Greece alone. Caroline, what is the strength of Brussels in this pandemic? Do they have the strength of Washington?
From a federal perspective, that's always been the weakness when it comes to the EU. And of course, COVID showed that front and center, the worries, the inability to perhaps buy the treatments that they wanted as swiftly as they'd hoped. That just erased some of that focus that had been that coming together within the Eurozone debt crisis. And now, once again, we see country by country decide their own path. And that doesn't seem to show much working together from a federal perspective that we see in the US at the moment.
At least it falls into what we're going to do. Anna Hahn and Chris Crisanti to join us on the equity markets and the path forward here. But Lisa, I got to fold the pandemic fears that we all have really right into what does it mean for 2020 economic growth? Chairman Powell doesn't know.
2022, 2020,
yes,
unfortunately, we already know. You can write that.
Are we going to get a redux of 2020?
Are we going to get a redux? And what I thought was notable was that yesterday President Biden came out and he said that we face a winter of severe illness and death. The same time that central bankers around the world are shrugging off the implications of this severe winter of illness and death and saying it is less important than the inflation that we continue to see, and they are making a move. How do markets respond to this? Do they take the optimistic approach or do they take the pessimistic approach and think that perhaps we're underestimating the impact from this latest wave?
We're going to do the data check here right now. Pretty quiet in the markets, but let's go through it as road to VIX 21.22, and the markets with some weight to them. Futures negative 16, Dow futures at negative 35. The 2-year yield, importantly, from a 0.64 into 0.63 as well. The 10-year yield 1.42%. I do want to note one of the quiet moments of the week is the real yield. The 10-year inflation-adjusted yield has come back from a 1 level to a negative 1.04. That gets my attention. Lisa?
It gets my attention, Tom, because right now what you're seeing in the market is basically a repudiation of this idea that we have the threat of a more sustainable inflationary push. Basically, the acceptance of a transitory type of inflation. How else can you explain the flattening yield curve? How else can you explain the idea that we set such low long-term rates at a time when we hear of paradigm shifts? At 11 a.m., we hear from Treasury Secretary Janet Yellen. She's hosting a virtual financial stability oversight committee. She plans to focus on climate change issues as well as crypto assets, the Fed coin, how much the federal government should get into that. I'm curious, though, if she talks about the risk of a market that is addicted to Fed support. How does the Fed tighten financial conditions with the degree of debt that has been incurred at these very low rates, the potential disruptive force that the Federal Reserve could be? A huge conundrum a lot of people have been trying to wrap their heads around. 1 p.m., we get the Baker Hughes rig count. The reason why this is interesting, we saw it absolutely tumble in the face of the pandemic. The amount of oil that the United States produces absolutely plunged. It's come back, but not that much. And now we have this dilemma where we have oil prices kind of fluctuating. How much do they keep coming back? How much does the U.S. remain the marginal producer at a time when OPEC Plus has shown that they're going to increase production?
And Lisa, let's stay on this. This is important, folks. The oil game that we've covered here with all the different opinions, Deutsche Bank with a low price view and others well over $100. Lisa, the research piece, whether you agree or disagree, is J.P. Morgan, and they are saying simply shale won't come on this time.
Because frankly, investment in some of these facilities and the inflation in some of these supplies are cost prohibitive to bring things on super quickly. And at 1 p.m., we hear from a number of Fed speakers, Fed Governor Chris Waller and San Francisco Fed President Mary Daly. How much do they comment on the flattening yield curve? How much do they care? And how much do they reiterate what we heard from Jay Powell, that it is distorted by overseas investors if you look at the long end of the curve, and it is not something to take a signal from.
And Chris Waller, with his competencies from the St. Louis Fed, an important voice today. Right now, we begin our discussion on this Friday as you get ready for the weekend and to jump into next year. Brian Weinstein joins, head of global fixed income at Morgan Stanley. Brian, I really want to have a rich conversation here, folding in fixed income into the rest of the market. Everybody, come on, Brian, you know the cliche, don't tell anyone in equities. The fixed income guys are smarter. We all know that. Lecture the equity market now. What is your market telling stocks?
I won't comment on the equity guys, but the bond market does usually know. And what the bond market is saying is just what Lisa said, that the inflation problem is what is transitory, right? That there is no long-term impact, that there is no long-term fear, and that the Fed won't really get off the ground. I think you're seeing a little bit of that in some of the relative moves in the NASDAQ in the last few days, in that we're taking away some accommodation. And that's really all that's happening. We're still near the highs. There's not a lot of fear in risk assets. In fact, I'd argue that the Fed being unanimous in its decision, wanting to raise rates slowly, is actually long-term okay for risk assets, and long-term rates being low, the same.
Explain that, Brian. Why does it matter that they were unanimous?
Well, I think we've seen some discomfort in with the hawks anyway, with the policy, right? We have inflation, we have fairly stable markets, and yet we're buying billions of dollars of treasuries and mortgages a month. And I think by taking that away and admitting that we don't have to raise rates more than 3 times in 22 and 3 times in 23, at no point do even the hawks really have the Fed funds rate getting above neutral. Now, the market disagrees, right? The market thinks neutral is closer to 1.5, and the Fed thinks closer to 2.5. But the unanimity tells you that they're not really trying to aggressively tighten. They just cannot be in a position where they're pumping liquidity at a time where inflation is as uncertain as it is and trending higher.
And so, Brian, we stick with a negative real yield and we try and search for more yield in corporate world and high yield world?
I mean, our clients have really spoken with their feet this year. Yes, looking for income in places like bank loans, floating rate, where there isn't as much duration, and in the corporate world, if they can find it. When the front end sells off like it has, you see how much cash is in the Fed's repo facility. So move out the yield curve and capture a 70 basis point 2-year note or a 1% corporate rate in the front end. It's not super exciting, and our equity friends will be happy because it keeps money flowing there. But yes, look for yield and don't expect rates to go wildly higher.
Brian, Tom Keene raised this conversation saying that bond traders are smarter than stock traders, that the bond guys are the smartest guys in the room. Are they this time? Or is the bond market not as predictive, not as much of a signal because of the distortion that, frankly, Fed Chair Jay Powell himself pointed to in disregarding the long end?
Listen, there are definitely technical factors that keep longer rates down, and it's been a risk for a while since QE has been such a prevalent policy. But the truth is, with the exception of the last couple of months here where inflation's really spiked, which the market really did not predict, the bond market anyway, it's been pretty correct, right? It's been hard to keep long-term growth rates in developed worlds high. We'll see if inflation stays sticky. So there's a risk, but as the Fed pares back QE, we'll find out.
Alan Zentner says core inflation is going to turn in February, March of next year. I don't know where it's going to go, but let's call it Greenspanian quiescent. What does your 10-year yield do if Zentner's correct?
It probably inches higher, but, again, I've seen a chance for 10-year notes to get closer to 2% over the next couple of months. It seems like it's a lot higher than here, but we were 170 a few weeks ago. So I think 10-year notes stay in a range as long as the Fed sticks to its guns. And it does not let inflation be out of control.
Brian Weinstein, thank you so much with Morgan Stanley. And I want to make clear that Mr. Weinstein was selected for Bloomberg Surveillance this morning only because John from Capri said get him on. Lisa, we listen to the fixed income guys now, and they're out there gaming the 10-year yield. Do they know what they're gaming, or is it just a guess?
Look, a lot of people are saying you can bet against the bond market, but every time you've bet against the bond market, you've been wrong. The bond market has been highly predictive. Whether you disregard it or not, it is the discount rate. So if it stays this way, how much does it continue to be supportive of risk assets at a time, even with inflation running hot, which is the reason why so many people come on and say real yields remain perpetually very negative, much more so than ever before, and will only go more so because of this dynamic that the Fed can't get out of because of how much debt we have.
And I'm glad you bring this up. I'm unclear on this. In Caroline Hyde, it goes to the inflation-adjusted yield, and will it stay the same? Will it get worse, as Lisa Abramowitz talks about, or do we actually get an improvement? In England, with 5.1% inflation, how painful is the real yield?
And with RPI and even in excess of that, I mean, it continues to be an absolute, from a person on a street perspective, yes, it hits you hard in your wallet. Of course, though, we've got an awful lot of debtors here in the UK who want to be more worried about where your mortgage rates go. But from where the central bank perspective is on the real yield, well, they're focused firmly on where inflation is at the moment, and that is where they tackle front and center. They've been far more hawkish, and they really surprised the market yesterday.
An extraordinary week. I really can't say enough about the linkage of Wednesday and the Federal Reserve into yesterday and what we saw from the shock of the Bank of England and from the ECB as well. You need to stay with us this morning. A special focus on the stock market. Anna Han, BNP Paribas, will join us, and also Chris Crisanti will join us from MAI and his search for value. It is a beautiful, festive New York. Good morning.
With the First Word News, I'm Leanne Gerrans. President Joe Biden is warning unvaccinated Americans that they face what he calls a winter of severe illness and death. The president is urging people to get initial doses and booster vaccines as coronavirus cases surge. He did say the spread of the Omicron variant has been slowed for now. Bloomberg has learned the U.S. is pushing the EU to finalize a package of sanctions against Russian banks and energy companies. They would be imposed if the Kremlin attacks Ukraine. The U.S. believes agreeing on sanctions would send a firm signal to Russian President Vladimir Putin. Now, here in the UK, it was a stunning political defeat for Prime Minister Boris Johnson. His ruling Conservative Party has lost a key parliamentary by-election to the Liberal Democrats. It was a seat the party has held since it was created all the way back in 1832. The loss could call Johnson's position into question. region. Goldman Sachs says it can now not rule out oil at $100 a barrel in 2023. That is because supply additions are expected to be slow to keep up with demand. Goldman's base forecast is for Brent to stay around $85 over the next 2 years. The bank says that consumption of gasoline, diesel and plastics is expected to reach new highs. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
To cut emissions, climate-proofing transportation is at the top of the list. 20% of global CO2 emissions come from transportation. 75% of transport emissions come from road travel. And 45% of road travel emissions come from passenger vehicles. 29.4% of road travel emissions come from freight. Of the world's transportation emissions, 11.6% comes from aviation, 10.6% comes from shipping, and 1% comes from train travel.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From the worker perspective, a recent headline, you got Kellogg's Cereal Union says the latest agreement that they had was rejected. Deere had to finally make a union contract. How concerned are you about the longshoreman contract and union negotiations right now?
Well, we're some time away from that. The contract expires on the 30th of June next year, and both sides have told me that they'll sit down to the table and begin negotiating in May. These are always important discussions, and usually when the spotlight is on our industry. But there'll be some issues around wages. The industry is making a lot of money. The longshore folks would like to see that. Now, I don't speak for either side, but training and development of the workforce will also be key as robotics and automation are front and center. The workers cannot be left behind.
Yeah, but to that point, I mean, do you feel like the balance, though, has shifted? I mean, for so long, workers had a lot less negotiating power. Do you feel like the pendulum's shifting?
The International Longshore and Warehouse Union, which does work across 29 West Coast ports, is very strong and a democratic organization.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Happy holidays from all of us at Bloomberg.
winter of severe illness and death for unvaccinated.
Not funny. We welcome all of you worldwide as you adjust, and all of us at Team Surveillance adjust in this holiday season to a new round of pandemic. As from Johns Hopkins University yesterday, Christopher Breyer, the great epidemiologist, truly expert on Thailand, made very clear what part of this is Omicron, what part of this is the seasonal effect of the virus. Lisa Bramwitz and Caroline Hyde with me, Jonathan Farrell off somewhere on sabbatical, and Emily Wilkins, not on sabbatical, joins us from Bloomberg Government. Emily, we should be talking about Build Back Better and the failure, but I think we've got to go to the pandemic right now. How in lockstep is the Biden administration with Capitol Hill and with the institutions we're trying to trust, CDC, WHO, and the rest of them? How tight is everybody coordinated?
Well, it's a little difficult to say that just because Congress is so diverse. You've got so many various voices out there. You've got the messages from Democrats saying that everyone needs to get vaccinated, get their booster, continue to take precautions. You've got Republican voices saying mostly that they are pro-vaccine, but that they don't think there should be any mandates. And you saw that recently with the Senate attempt, mostly Republicans, but joined by 2 Democrats, to overturn President Biden's mandate on companies that they need to have their employees vaccinated or tested. And so you are hearing a bit of the mixed message at this point, but really the Biden administration, right from the start, they hitched their sleigh to being the administration to get everyone past the pandemic, and they are struggling to do that because both of these new variants and a lot of hesitancy to vaccinate.
I'm looking at John Burns Murdoch's beautiful work at the Financial Times. I've relied on it, Emily Wilkins, through this entire pandemic. And Zero Hedge had a word yesterday they invented, as they do, and it was called case-demic, in that we're having a frenzy about cases, but that hospitalizations and deaths, at least not yet, aren't linked up with the agony we're feeling about cases. Does Washington make the nuance, the distinction between cases, hospitalizations, and death?
Absolutely. And I think to a certain extent that happens because that's when everyone really begins to panic, is when the hospitals are full, when they can't take people, when people who need other surgeries and other medical help have to be turned away because every bed is taken. And there has been some early discussion on Capitol Hill about potentially having legislation to address the new Omicron variant and some of the effects that we're seeing. But at this point, and you kind of hinted at this, Tom, with the whole Build Back Better package, there really isn't a lot of willpower to move major pricey legislation at this point.
How controversial was Tony Fauci, the head of the health department, his proclamation that there is not the need for another vaccine that targets the Omicron variant, that what we have, especially with the boosters, is just fine?
Well, I think Fauci, he's become a very politicized figure, both on the left and on the right. And I think what you're hearing, though, is a message that really goes back to what the Biden administration has been saying, which is trying to really encourage people to get vaccinated, get their boosters. We've heard this from experts that in reality, this pandemic, we can do the testing, we can do the masking, we can do the social distancing, but this is not going to be over until a significant portion of the population is finally vaccinated. And I think that's part of the message that Dr. Fauci is delivering. Yes, there are concerns about the Omicron variant. Yes, we're still getting information about how well the current vaccines hold up to it, but there is trying to encourage people to make sure they are getting their vaccinations, they are getting their boosters, even as we're still learning more about the new variant.
In the meantime, though, Emily, a lot of people are still unvaccinated, and we're not going to get them fully vaccinated before the winter time, before the peak of the season, and that is what the expectation is. How much is there any political will left for social restrictions, or is that off the table?
I think to a certain extent that depends on the locality. It depends on the state. It depends on the willpower of local leaders. I mean, look, here in D.C. late last month, Mayor Muriel Bowser relaxed some of the policies around masking. D.C. yesterday hit its highest number of cases since September. And so there is a certain extent of where you are, what your local leaders want. I mean, certainly, I live here in D.C., but when I go to other parts of the country, I'm always pretty surprised at how relaxed a lot of things doing with masking and social distancing are. So I really think at this point, it's largely in the hands of those local leaders, of heads of businesses. The Biden administration is trying to get the message out there, but there's only so much that they're really able to do in terms of continuing various mandates and bans.
Emily, the governors and the mayors, what are we expecting, could we expect, as we're about to all start to travel for the holidays here in Europe, as Tom has been rightly so focusing in on, Italy, Greece, going in alone, demanding PCR tests if you're traveling within the EU, Germany, France saying, no, that's not for us, but putting limitations on UK travelers. How much could there be any travel restrictions within a federal United States, or is that just completely off the table nowadays?
Really, nowadays, we haven't seen too many states putting in various bans. I mean, we have sort of all been alerted to the fact that the holiday season, cases are expected to spike. Obviously, you have, remember, there was a big spike around this time last year, and partly because winter is a time that people usually tend to get sick, in addition to being with families. But you already saw Dr. Fauci put out the message that people could spend Christmas with their families this year. You've seen the Biden administration message off of that, saying, look, even though we still have the virus with us, things are better than they were last year. And granted, that's now sort of shifting as we see the Omicron variant. But the Biden administration, they're really trying to sort of have their cake and eat it too, have the concern out there, but also show that they are making progress.
We love you, Emily, because you can do this. We're going to segue right now to important banners from Russia that we see. 3 banners lined up that involve Emily Wilkins. Russia says the United States should have no military ties with ex-USSR states. Russia says U.S. must not set up bases in ex-Soviet states. Russia proposes U.S. deny NATO membership to ex-Soviet states. How important are these headlines, Emily Wilkins?
There's something I think that lawmakers are increasingly watching closely, especially with the buildup on the Ukraine border. This is something that Washington has very much pivoted their attention to. And there's a strong amount of bipartisanship when it comes to the U.S. dealing with Russia and dealing with them in a strong and aggressive way. There was actually a really fascinating number of tweets from a lawmaker saying that, a Democratic lawmaker saying that they should be aggressive on Russia, and immediately had a number of Republicans backing him up.
Emily, we got to run because of time, but this headline out moments ago: NATO must return European forces to position in 1997. That from Mr. Rabakov. Emily Wilkins, thank you so much. And this is a movable story in our international relations. It's extraordinary, Lisa. And I think of Ian Bremmer, and of course, the joy of talking to him about the risks of 2022. You wonder, Lisa, how much of a risk will be our relationship as we redefine Eastern Europe.
And the fact that Russia seems like it is not backing away from a potential invasion in Ukraine, how much does the Western nations, how much do they have in terms of leverage, considering the gas supplies to Europe and considering the lack of willingness to really cut that off right now, Tom?
And of course, utility prices in Europe, the United Kingdom, extremely sensitive this holiday season. Coming up, our conversation of the day on monetary theory. We're thrilled. Claudia Sahm will darken the doors. Stay with us. This is Bloomberg on radio, on television.
an extra $1 trillion in spending, not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we frankly have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became transportation secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been